Okay, good evening everyone. Welcome to Byju's Exam Prep IAS. This is Sham Kagudia. Now, before I start the discussion, if there is no issue with the sound, can you please give me a thumbs up so that we can start with the class today? Done. Thank you. Okay. Now, what we'll start today? We'll start with a new chapter, that is the concept of money and banking. Now, before I start the session, what we have covered yesterday? We have covered yesterday the concept of taxation, furthermore concepts within the taxation. That is, we have discussed the idea of a compensation. I hope remember we started with the compensation itself. What is a compensation? When GST was introduced, we would simply take away the indirect taxation powers from the states. Now, because we are taking away the indirect taxes from the states were concerned about the revenues that they were collecting. And in order to ensure that they will not forego the revenues, they will not have revenue losses, the government introduced the concept of compensation, under which from 1 year to next year, we would simply assume, right, the tax revenues will increase under the concept, tax revenues will increase by 14%. And whatever is the GST collected, if there is a difference, there is a revenue loss, government will provide it. Government of India will provide the compensation. That was basically the idea of a compensation. And after that, we have discussed a GST network, right? What is a GST network? A GST network is basically the institution or an authority which has been established, which will ensure that the benefit of tax rate reduction will be provided to the consumers or will be transferred to the customers. There is no profiteering activity. I'm sorry, I'm talking about National Anti-Profiting Authority. National Anti-Profiting Authority has been established in order to ensure that there is no profiteering activity. Whatever is the tax rate reduction, complete benefit of that will be provided to the customers. After that, GST network, right? It is a non-profit organization. It has been set up or established under Section 8 of Companies Act. Under this, the idea is it will simply provide infrastructure services. It is an infrastructure backbone service provider. And that is a GST network. Then we have discussed what are the issues or certain important concepts within the taxation. That is a tax buoyancy, tax elasticity, the tax to GDP ratio. Tax buoyancy basically measures with a percentage change in the GDP, what is the percentage change in the taxes collected. And that measurement is called as a tax buoyancy. And tax to GDP ratio, whatever is the value of the tax divided by the value of the GDP. And there itself, I've told you what are the reasons why the taxes collected in case of India are generally lower compared to other countries, why our tax to GDP ratio is on a lower side. Then we have discussed tax elasticity. What is elasticity there? With, let's say, a change in the tax rate, with 1% change in the tax rate, how much will be the changes in the tax revenue collection? That is basically the idea of a tax elasticity. Right. In addition to this, we also discussed the idea of a tax expenditure. What do you mean by tax expenditure? Tax expenditure, right, basically measures how much is the tax exemption provided by the government, how much tax revenue is foregone by the government. Right. That is basically the idea of a tax expenditure. Then what are the issues in the taxation structure in India? What are the issues? There is a tax evasion, tax avoidance is there. Then there is a no taxation on the agriculture sector. Large part of the economy is informal, not registered with the government. Black money generation is very high, etc., etc. These are the concerns. Then we have also discussed the concept of, right, the reforms that have been implemented by the government. What kind of reforms? We have discussed GAR day for yesterday. We have discussed MAT, minimum alternate tax. We also have discussed right, various other reforms, BPS, etc. Yesterday, one more very important reform: transparent taxation. There is an idea of a transparent taxation, honoring the honest, under which we will have faceless assessment, faceless appeal, as well as the taxpayer charter. And finally, after all of it, we discuss the concept of Laffer curve. Laffer curve basically says whenever the tax rates are increased, the amount of tax revenue that you collect will increase. But it will not happen always. After you reach a certain threshold level, after you reach the optimal tax rate, and if you increase the tax rate above the optimal tax rate, then the taxes collected will not increase, rather will start decreasing. That is basically the idea of a Laffer curve. Okay, now let me start. Right, questions are left out. There are a couple of MCQs as well as a descriptive questions related to taxation. We'll have a discussion regarding that today. Please don't worry. Now let me start with another very important chapter for your UPC examination, the idea of a money and banking. Right, very big chapter. A lot of current affairs. We'll have a discussion on this in this chapter. And if you check the previous year questions, which I strongly recommend you people to do, you will realize that in the last 5 years, no questions in the mains examination. I repeat, no questions in the mains examination has come from the chapter of banking. But that doesn't mean that this chapter is useless. That doesn't mean that you will have to ignore this chapter. Very important. Why? If you look at all the questions, generally around 15 to 17 questions will come in the UPSC preliminary examination. Around 4 to 5 will come from this chapter, that is banking, right? And most of them are from the current affairs itself. Now let's start. These are the list of the topics that we'll be discussing in this chapter. Again, certain current affairs are there, it is not listed. We'll have a discussion. Now let me start with the basic idea. What is money? The most basic idea, right? What is the meaning of the term money? I'm pretty sure all of you have money, right? Some will have 100 rupee, some will have 500, some will have 2000 rupee, willing to go to the bank and now exchange it, etc., etc. All of you have money. Now what is the meaning of the term money here? What is essentially the meaning of the term money? Money, please understand this, money is basically a mode of exchange. Money is nothing but it is a mode of exchange. What do you mean by mode of exchange? Let's start. Hundreds of definitions are there for money. Please don't by heart everything. Understand the basics more than sufficient. Let's start. Imagine you'll go to the market. You want to purchase the bottle. Please tell me, when you want to purchase the bottle, what will you pay? Right? Because you'll have to pay something in return. It is basically an exchange that you're doing. You will go to the shop. Imagine I'm the shop owner. You will come to the shop. You will purchase the bottle, and in return, you'll have to pay me something. You'll have to give me something. Is it okay if I say there is an exchange that is happening? From one hand, I will give you the bottle. In the other hand, I will collect the money. It is basically an exchange. But to conduct this exchange, we need certain, right? On the other side, we need certain other item also. What is the other item I'm talking about? I'm talking about money here. I'm talking about rupees. The rupees that you will have in your pocket, that is basically the mode of exchange. And it is important for a very simple reason. Understand the logic here. Anything in the market, you will represent the value of it in terms of rupees. Is logic okay with you? Anything that is available in the market, we represent all of them in terms of value of rupees. You will go to the market, you want to purchase a mobile. It is represented in the form of rupees, value. You will go to the market, you want to purchase, let's say, right, a jeans. It is represented in value terms. You want to purchase, let's say, Mercedes-Benz car. You want to purchase, right, let's say, gold, diamond. For everything, the representation is always in terms of rupee. So money is required, and money is basically nothing but a medium or a mode of exchange, wherein for anything in the market, you will pay money, and in return, you will get certain good or service. That is basically the definition of the money. Now today, right, I hope you understand, today all of us use this kind of a money. Can you see this note in my hand? Currency in my hand. Of course, I don't have 2000 rupee currency note, 100 rupee currency note, right? So this is a currency note. This is nothing but money. Money today I'm talking about today. Money can be represented in the form of currency notes or currency coin. There's a coin. Don't worry about denomination of the coin. 1 rupee coin. So money today can be represented in the form of a currency note or currency coin. But if you look at it historically, we do not have, or we did not have, the currency coins and currency notes from the beginning itself. Earlier what we used to have is the concept of commodity money. Understand the logic here, right? Earlier we had a concept of commodity money, right? To begin with, it was basically a barter system. Most of us saying barter system. To begin with, it was basically a barter system. Barter means what? Anything is right, a good or a service, it is exchanged. It is used as an exchange for any other good or a service. But please understand the problem with the barter system. Imagine you have manufactured, again, old times, right? I hope you understand the problem here. I cannot carry, right, let's say papaya, I cannot carry bananas in the classroom. Imagine in the old times when there was no currency note and a coin, you manufactured this bottle. Okay, you wanted to sell the bottle, and in return you wanted to purchase, let's say, apple. But don't you think in that situation, you'll have to find out somebody else who is willing to purchase the bottle and he has apples to sell? There's a technical term for this. This is called as a coincidence of wants, right? That is, you have a bottle, you want to sell the bottle, and in return you want to purchase apples, which means you'll have to search in the market somebody who is willing to sell apple and willing to purchase bottle. That is a concept of double coincidence of wants. But there's a problem with that. It is basically a barter system. There's a problem with that. What is the problem? Imagine you have cultivated not the bottle, you have not produced bottle, you have cultivated, let's say, vegetables. Now, if you keep on searching, right, for someone else who wants to sell a bottle in the market, and it will take 1 day, 2 days, 3 days, etc., what will happen to your vegetables? Right? Vegetables cannot be stored over a period of time. In a very short period of time, they have a very short shelf life. The value will be lost. Right? Perishable items, agriculture sector, perishable items. So that was the biggest problem with the barter system. Now look at the situation. You have introduced the concept of currency notes. You have introduced the concept of currency notes. Now, don't you think the currency note or a currency coin will address this issue in the barter system? That is, I have a bottle, I'll sell the bottle to you, I'll collect 100 rupees from you, and I will use the 100 rupee, go to the market, pay 100 rupee, purchase apples from someone else. Is it okay? I'll repeat it again. It's a very basic idea. I have a bottle, I'll sell it to you, you will give me 100 rupees. I will take the 100 rupees, I will go to the market, I will pay 100 rupees and purchase apples from the market. Right? That is basically the importance of the currency notes or currency coins that we're using today. Now, after the barter system, right, somewhat similar to barter system, we introduced the concept of commodity money. Now, what is the idea of a commodity money? Commodity money is that kind of a money where commodity is actually used for conducting transactions. Commodity is used for conducting transactions. Commodity itself is used for exchanges in the market. Sir, any example of a commodity? Gold. I've written here. Gold. Right? Beads, shells, spices, etc. In commodity money, the commodity itself, for example, imagine I have gold. Imagine I've got gold. Right? I will simply use this particular gold and, right, instead of 100 rupee, right, I hope you understand this. Today we have 100 rupee. Commodity money means instead of 100 rupee, I've got gold. So I will basically sell gold, purchase a certain goods or services in the market. That is the concept of commodity money. Spices were used for conducting transactions. Right? Beads, shells were used for conducting transactions. Right? Silver was used for conducting transactions. Gold was used for conducting transactions in the market. So whenever commodities were used, right, that money is referred to as commodity money. Now, point number 2, have a look at this. Point number 2, right, in case of commodity money, whatever was the value of the commodity, right? There's a term here, intrinsic value, right? There's a term called as intrinsic value. Now, please tell me, does this currency note, I hope you understand this, does this currency note have any intrinsic value? Intrinsic value means this is piece of paper. All of you can understand this? This is nothing but piece of paper. Now you tell me, does this piece of paper have any great value in the market? But on the other hand, right, imagine you hold a bar of gold on the other side. On one hand, you're holding piece of paper. In the other hand, you're holding, let's say, piece of gold. Now you tell me that piece of gold, does it have a market value or not? I hope you understand the logic here. On one side, you're holding gold. Does gold have a market value? Yes, there is worth, there is a value for the gold in the market. But this piece of paper does not have any value in the market, which means, right, understand the logic here, the value of the commodity decided what would be the purchasing power in the market. That is, let's say 1 gram of gold, you're holding 1 gram of a gold. So that 1 gram of gold would determine how many coconuts you would be able to purchase in the market by giving 1 gram of gold. That 1 gram of gold would determine how many, let's say, horses you can purchase by giving 1 gram of gold. So the commodity itself had value, and that value would determine what would be the rate of exchange in the market. That is basically the concept of commodity money. Now, some of you are asking, why is this not equivalent to barter system? I've written it is very closely related to barter system, but it is not equal to barter system. Because in the barter system, please understand, it is an exchange. You will give A, you will basically sell A and you will purchase B. A could be coconut, A could be banana, A could be a horse, A could be anything. But in case of commodity money, only commodities. Commodities means, right, very precious things which have market value. Right, very, very precious things which have lot of market value. These are referred to as a commodity. For example, let me know, right, is crude oil a commodity? Think of it. Is crude oil a commodity? Is gold a commodity? Is silver a commodity? Is platinum a commodity? Generally, yes. Right, so these have got very, very good market values. These are called as commodities. Right, so commodity money, this is a basic idea. But over a period of time, we shifted from the concept of a commodity money to fiat money. Current affairs will discuss, understand this very carefully. From the commodity money, we have shifted to the concept of fiat money. And there's a particular reason why we have shifted. Can you always use gold for conducting transactions? Think of it. Don't you think the amount of gold that we have is limited? Right? Can you always use gold or silver for that matter for conducting transactions? That's not possible. That's the reason over a period of time what we have done is, rather than using commodities, we have shifted to the concept of fiat money. And the best example for fiat money is any currency note that you have and any currency coin that you have. And if you ask me, sir, what about 2000 rupee note? Most of you will run to 2000 rupee note now. For everything, you will go to 2000 rupee note. Sir, what about 2000 rupee note? As far as RBI is concerned, till the end of September 30th, even that is also fiat money. Now, what is the meaning of the term fiat here? Fiat simply refers to order. Fiat simply refers to order of the government. For example, if you have a currency note, please open it. Again, right, don't waste your time. Quickly, I'll tell you only one point. Please open the currency note and have a look at the currency note. It is called as a front side. And generally where Gandhiji's bust is present, that is called as a front side. And if you look at the front side, there is right one point that you can see, right, that is generally on the right side in the front side. You will see RBI Governor's promise. Can you see that? There is an RBI Governor's promise, right? It basically says anybody who holds this currency note, I I promise the bearer of there's so much, etc. Don't by heart it. It's not preamble. You don't require it for UPSC. But what is the meaning of that promise? Promise simply is a order. The government of India, through an order, has stated this piece of paper will carry the value of 100 rupees in the market. Any problem with this? The government of India, through its order, says this piece of paper, right? This piece of paper will carry the value of 100 rupees in the market. Now, if the government of India can provide value through an order, is it okay if I say government can also withdraw the value through an order? Any problem with this? If government of India through an order, if they can give the value to the currency, can they also withdraw the order? Of course, yes. Has it happened in the past? My dear, 2016. Please dial your memory back, right? 4 years ago, 2016. Has it happened or not? On a very fine night, 8:30, right? November 2016, you switched on the TV and right, Prime Minister was standing and they demonetized. Demonetization means what? Withdrawing the value, right? They, through an order, basically said, I am going to withdraw the value of the currency, right? That is basically the idea of fiat money. Any problem with this? Now, second point, already I've told the answer to this. Tell me, does fiat money have any intrinsic value? Does fiat money is nothing but piece of paper here. Does it have any intrinsic value? No. Fiat money doesn't have intrinsic value. Right? They do not carry any intrinsic value because it is simply a piece of paper. That's it. It's simply a piece of paper. Point number 3. They carry very, very high liquidity. Please understand this term. The fiat money carries very, very high liquidity. Now you will ask me, sir, what is liquidity? Let me explain this, and questions have been asked on this. What is the meaning of the term liquidity? It is the feature. It is the feature of an asset. It is representing feature of an asset, which means how quickly can it be converted? Can it be converted into money? Can it be converted into money? I'll repeat it again. What is the meaning of the term liquidity? Liquidity, it is a feature of an asset. What is the feature? It focuses on how quickly can you convert this asset into money. And I hope you understand, money means a mode of exchange, a medium of exchange. For example, let me know. Imagine you're the shopkeeper. I will purchase a lot of goods from your shop. You will prepare a bill and I will open gold and I want to pay in terms of gold. Will all of you accept it? Think of it. Will all of you accept it? Some of you will simply say, yes, sir, I will accept it. But my dear, are you sure the gold is pure? Are you sure it is gold in the first place? But on the other hand, I will remove the purse and pay 100 rupees. Will you accept it? So 100 rupees is the money here. 100 rupees is a money. Gold is an asset, but it is not money. We are not talking about commodity money here. 100 rupees is the money. Gold is not money, it is an asset. But can we convert gold into money? Answer is yes. Can we convert this gold into money? Yes. I can go to, let's say, a gold shop, sell the gold, and in return, I will get money. So what is the meaning of the term liquidity here? Liquidity refers to feature of an asset which is representing how quickly the asset can be converted into money. Now, simple question to you. Is this 100 rupee note that I'm holding, is it visible? Is this 100 rupee note that I'm holding, is it an asset? Tell me, the 100 rupee note, is it an asset or not? Yes, it is an, some of you are saying no. My dear, asset means what? Asset is anything that will fetch returns to you. Is the 100 rupee an asset to you? Yes, it is, yes. Right? I don't know why some of you are getting a doubt here. Right? We have been discussing the concept of asset multiple times now. Right? So this 100 rupee note is an asset. Do you need to convert it into money? Question number 2. Do you need to convert this into money? No. Now can I simply say the currency note has highest liquidity? Think of it. Can I say that the currency note that I'm holding has the highest liquidity? Can I go to the next one? Now on the other side, what about gold? Tell me, gold, is it an asset? Gold, is it an asset? Yes. But can I say that gold has a very high liquidity compared to a currency note? No. Gold has lesser liquidity. Gold has lower liquidity, lesser liquidity compared to a currency or cash with you. Now I'll give you 2 examples. Tell me which has the higher liquidity. Imagine you have 100 rupees. You will take 50 rupees, keep it in the savings bank account. Let me see how you actually think of it. You will take 50 rupees, keep it in the savings bank account. You will take another 50 rupees, keep it in the fixed deposit. I will write this fixed deposit as number 2, savings bank account as number 1. Tell me which has higher liquidity, 1 or 2. Tell me which has higher liquidity, 1 or 2. Right? Most of you are saying 1. That is absolutely correct. Anybody has a doubt here? 1 is the right option. Between savings bank account and the fixed deposit, savings bank account will have higher liquidity. And that's a fact, by the way. If you ask me, sir, how? Why? Underline the term quickly. How quickly you can convert this into money? You have kept 50 rupees in your savings bank account. Can you withdraw this at any point of time? Think of it. Can you withdraw this 50 rupees at any point of time? Again, you don't have to go to the bank only. You can simply take your debit card, swipe. Right, left, right, center, keep on swiping. Or, sir, I don't want to use a debit card. Right, in that case, what I'll do? You can use UPI. Connect UPI to your bank account. Can you do the transaction, right, from your savings bank account? Of course, yes. Can you write a check, right, to me? Again, just hypothetical example. Can you write a check in my name? Of course, yes. But on the other hand, what about fixed deposit amount? Can you withdraw directly from the fixed deposit account? No. First, you will have to close the fixed deposit. First, you will have to close the fixed deposit. Money will be transferred into a savings bank account. Then you're allowed to use the money. Now, based on this, can I simply say that a savings bank account has a higher liquidity compared to fixed deposit? Right? That is basically the concept of liquidity. Now, come back to the idea of a fiat money. Based on all the discussion that we have had so far, can I say that fiat money has a very high liquidity? Fiat money has very, very high liquidity in the market because you don't need to convert. It is already in the form of money. Right? That 100 rupee note, 500 rupee note, right? Old 1000 rupee note, no, that is not fiat money now. Right? But 2000 rupee note, all these are nothing but fiat money, have very, very high liquidity in the market. Examples of fiat money are coins as well as the currency notes. Right? The currency coins and currency notes. Okay? Right? Next, third type of money, fiduciary money. Third type of money, that is fiduciary money. Now, what is the meaning of the term fiduciary money? Let me start with an example. Then we'll come to the discussion. Then we'll look at the points. Imagine you have a very, very, very big shop. Very, very big, right, electronic shop. I'll come to a shop. I'll purchase, let's say, 2 lakh rupees worth of electronics. Okay, I'll purchase 2 lakh rupees worth of electronics. Question number 1. I will write a check in your name. Tell me, will everybody accept the payment through the check? Let me know. Will all of you accept the payment through the check? Right? You should say no, by the way. You should simply say no. Why? Sir, right, because, right, I know you. Right, I know your name. If you don't make the payment, I'll put it in the Facebook. Right, I'll harass you. That could be your argument. But on the other hand, what if I'm an unknown person? I don't know you, you don't know me. I'll come to a shop, I'll purchase 2 lakh rupees worth of, right, let's say the goods. I'll write a check, I'll give it to you, I'll take the goods and run away. Tomorrow you will go to the bank, present the check, and the bank manager says, sorry, sir, the check is correct, check is genuine, but there is no money in the account. I hope you understand. Right? The check is genuine one, right? But there is no money in this account. Right? That is called as a bouncing of the check. Right? Check bounce will happen. Now in that case, right, I hope you understand whether you will accept the payment through the check. I hope you understand my point here. Whether you accept the payment through the check depends on you. Any problem? Let me know. Whether you will accept the payment through the check entirely depends upon you. That is the receiver of the payment. That receiver will decide how much confidence they have on the check payment. For example, imagine we conduct lot of trade between us. Right? We have lot of trading. Every week I will purchase the goods from your shop only. In that case, don't you think because there is a very good relation between both of us, even if I make a payment in the check, you will accept it? I hope you understand. Confidence is very important here. Right? You have a lot of confidence on my payment, and because I keep on conducting transaction with you, right? We have been doing this for many years, which means you have got very high amount of trust on me. So when I make a payment through the check, you will accept it. So have a look at this. The value associated with this fiduciary money. Fiduciary money is basically, understand this, fiduciary money or the bank money. It is that kind of a money which is basically issued by the banks. It is that kind of a money which is issued by the banks in the form of checks or demand drafts. Have you heard of DDs? DD, demand draft. Who will issue the demand draft? Bank. Who will issue, right, the check? Right, that will also, right, be issued by the bank. So, Arey Baba, you have not seen demand drafts? Some of you are saying no. Have you never heard of the demand draft? Today I do agree. Today it's not very famous. But earlier, a lot of payments were actually done through the demand drafts. That is, basically you will go to the bank, you will make a payment, the bank will issue a instrument. You will take it and make a payment. Earlier it was very famous. Today it has become outdated. For example, you are supposed to make a payment to, let's say, for certain examination purposes. You are supposed to make a payment for college fees. You want to get admission into, let's say, medicals, etc. Earlier it was basically demand draft. Again, you have not heard of it, don't worry. UPSC is not going to test you here. But who issued the demand draft? Banks issued the demand draft. Who issued the checks or who issues the checks even today? The banks issue the checks. Okay, so understand the logic here. Fiduciary money, or it is also referred as a bank money, right? And this money is issued by the bank. It is issued by the bank, and the receiver's confidence or the trust on this money will determine whether this will be accepted in the market or not. And there is one next point here. Very often in the last 7 days, this term has been thrown left, right, center in the newspaper. That is legal tender. There's a term called as legal tender. Now, understand the term of legal tender. Legal tender means any money that is notified by the government. The money that is notified by the government. Any money that is notified by the government, point number one. And point number two is this will be used for settlement of the debt. This will be used for the settlement of debt. Now, do you remember the term debt? Do you remember the concept of the term debt? Debt means you owe money to someone else. You'll have to make a payment to someone. That is called as a term debt. Now, let me give a very simple example. You will come to my shop. You will purchase the bottle. Now, please tell me you are in a debt or not. You will take the bottle. You are yet to make the payment. I hope you understand. You are yet to make the payment. You will take the bottle. You will purchase the bottle. Are you under the debt or not? Yes. So in order to settle the debt, what you will do? You will make a payment of 100 rupees to me. So point number one, is this 100 rupee notified by the government as money? Point number one, is this 100 rupee notified by the government as money? Yes. Point number two, can you use the 100 rupee to settle a transaction, to make a payment, to settle the debt in the market? Again, yes. Now, can I call this as a legal tender? Can I call this 100 rupee as a legal tender? Answer is yes. Now, on the other hand, check is not a legal tender. I hope you understand. Check is not a legal tender. Why? Government has not declared that you can settle debt using a check. If government had said that, imagine if government says that, okay, right, which means henceforth, instead of using 100 rupee, you'll purchase something and you'll start, right, making a payment through the check. Right? Don't you think in the market, always checks are not accepted? I hope you understand. In the market, very few people will accept payment through the check. It all depends on the trust that they have with you. Most of the shops will have a very clear board. No credit, no check, only cash. Have you seen the board? Right? No check, no credit, only cash. Because they don't have confidence on anything else except fiat money. They do not carry any confidence on any other mode of a payment except fiat money. That is basically the idea of a fiduciary money. Okay. Now, finally, commercial bank money. Finally, the concept of commercial bank money. Now, please understand the difference between fiduciary and commercial bank money. Some of you just get confused. In concept of fiduciary money, I'm talking about a check. I'm talking about a demand draft. Whereas in the concept of commercial bank money, it refers to the money that is created by the bank. Right? In context of commercial bank money, it refers to the money that is created by the banks. Sir, what is the money created by the bank? Let me give you a very simple example. I'll go back to previous slide. Understand the logic here. Now, imagine step one. A has 100 rupee. I have 100 rupee. I will go to the bank. Okay, I'll go to the bank. I will make a deposit of 100 rupees with the bank. Okay, I'll make a deposit of 100. Now, the bank will not keep the 100 rupees with itself. What the bank will do is, it will keep some amount of money in the form of reserves. Do not focus on this. I repeat, even if you ask questions, I'll not answer on this. Have patience. In RBI, I'll tell you about this. Bank will keep certain amount of reserves. Remaining amount of money, they will give it in the form of loan. Let's say they will give it in the form of loan to company A. Now have a look at this. Company A has taken the loan of 90. Now can I simply say that bank on one side, understand the logic behind this. Bank on one side will say that they have a deposit of 100 rupee. They have a deposit of 100 rupee. And on the other hand, the bank also has given a loan of 90 rupees. Now, can I simply say that this loan, the amount of loan that is given by the bank is nothing but money that is created by the bank? Let me know. Money that is created. The bank is not printing money. Please do not misunderstand my statement. I repeat, the bank is not printing money. Bank is simply creating money. Right? They have collected deposit of 100, but out of 100, they will simply take 90 rupees, give it in the form of loan. That 90 rupee loan is money created. I'll give you one more example. I'm pretty sure a lot of you people have got credit card. Think of it. Have got credit card. Now, when you use the credit card to swipe in the market, do you think the bank will literally come, throw 100 rupees in your pocket and run away? I'm talking about credit card. I hope you understand. Right? You have a credit card. Right? What is a credit card? Bank says you use the credit card to make a payment now. Give me the money afterwards. Make a payment after 45 days. Make a payment after, let's say, 30 days. Now you tell me you are using a credit card, you will swipe and you will purchase, let's say, a product in the market worth 100 rupee. What does it mean? The bank has given a loan of 100 rupees for you. The bank has given a loan of 100 rupees to you. Is the bank printing 100 rupees here? Let me know. Is the bank printing 100 rupee? No. But can I simply say that that 100 rupee loan is the money that is created by the bank? Any problem here? That is, loans which are created by the bank, it is called as a commercial bank money. Right? That is called as a commercial bank money. Now, I've given a table here. Do you need to buy at the table? Absolutely no. Please don't waste your time. But what is happening in the table? Let me explain it. The 90 rupee loan is given to a company A. Company A will take the loan and let's say will purchase a product from company B. It could be a raw material, etc., etc. Now, what B will do? B has received a payment of 90. B will deposit that 90 rupees with the bank. Now, again, the bank has to maintain certain reserves. And right after this, right after out of 90 rupees, bank will keep 9 rupees with itself. And remaining amount, again, it will give it in the form of loan. Again, it will issue it in the form of loan. And as a result of this, what will happen? Right, have a look at this. Company C will take a loan of 81 rupees. And again, they will purchase, let's say, a machine from company D. And company D, which has received 81 rupees, will deposit this money with another bank. And this bank will keep some amount out of it, and remaining amount, it will give it in the form of loan. Now, please tell me, is there creation of loan in the step 1, step 2, as well as step 3 or not? I'll repeat the question here again. Can you see creation of loans? Creation of loans, not printing money. Creation of loans in every one of the 3 steps. This is called as commercial bank money. This is basically referred to as commercial bank money. And in case of India, the commercial bank money will work or will be created because of a system called as fractional reserve system. Fractional reserve system. What is the meaning of the term fractional reserve system? Fractional reserve system refers to a system wherein bank will collect a deposit. Part of the deposit, they will keep it with themselves. I repeat, and later you will understand, today itself you will understand why they will do that. Part of the deposit, they will keep it with themselves. Remaining amount, they will issue it in the form of loan. That is basically the concept of, right, a fractional reserve system. And in case of India, we follow fractional reserve system. Done? So these are the 4 types of money. Commercial bank money, it is a money that is created by the banks through a fractional reserve system. It is a debt generated by the banks which can be exchanged for money. Right? That is basically you are taking a loan. Right? You are taking a loan. Debt means what? Nothing but borrowing. You are taking a loan, but you can get it converted into the form of money. Right? That is basically the idea of commercial bank money. Okay? Right? So these are the 4 types of monies. These are the 4 types of monies. 1, the concept of commodity money. Second one is a fiat money. Third one is a fiduciary money. Fourth one is a commercial bank money. Okay. Now, let me go to the next one here. The structure of banks in India. The banking structure in India. What is the structure of bank in India? At the top of banking structure, we have Reserve Bank of India, RBI. We have Reserve Bank of India. And below Reserve Bank of India, we have a classification called as commercial banks. And the commercial banks are divided into 2 parts. Commercial banks are divided into 2 parts. One is a scheduled and second one is non-scheduled. Now, many of you will start doing PhD here. So, what is a commercial bank? Any example? Tell me, have you seen a bank, SBI, Syndicate Bank, right? Or let's say Dena Bank, Bank of Baroda, Yes Bank. All these are nothing but commercial banks only. Okay. Now, scheduled banks, why are they called as scheduled banks? Please understand this. Scheduled banks are those banks which are registered, under Schedule 2, under Schedule 2 of RBI Act. I repeat, what are scheduled banks? These are the banks which are registered under Schedule 2 of RBI Act. And the moment you're registered under the Schedule 2 of RBI Act, one, it means you will come under the regulation, and we'll discuss regulations of RBI today. Don't worry. You will come under a lot of regulations of RBI. But more importantly, you can borrow from Reserve Bank of India. You are allowed to borrow, take various facilities where you are allowed to borrow from Reserve Bank of India. And what is the meaning of the term non-scheduled? Non-scheduled simply means these will not be registered under Schedule 2 of RBI Act. These will not be registered under Schedule 2 of RBI Act. Okay, that is basically the concept of scheduled as well as non-scheduled. Examples of scheduled banks, right? You have seen multiple banks. All these are the examples of scheduled banks. Yes Bank, Dena Bank, Bank of Baroda, SBI, Syndicate Bank, Punjab National Bank. All these are nothing but scheduled banks. What about examples of non-scheduled banks? I've given you a picture, right? There is a list of 10 non-scheduled banks. In fact, the list is very, very large. You don't have to buy heart. You please do not buy heart this also. Just to give you an idea, are there any examples of a non-scheduled banks? I've given a list of 10 non-scheduled banks in India. But there are many more. Please do not waste your time. Do not start by hearting because I've given the list. The only reason I have given the list is, I know the moment I say non-scheduled and I go forward, many of you will ask me, give me example of non-scheduled. Tell me one example of non-scheduled. Right? I've given the list. Have a look at it. Okay? Now, let me enter into the Reserve Bank of India. Very, very important. Let me enter into Reserve Bank of India. And some of you, right, will start asking about public sector, cooperative, etc. We'll have a detailed discussion for all of them. Cooperative banking, separate. We'll discuss. Right? Under this chapter only. Right? RRBs, we'll discuss. Right? Scheduled commercial banks, we'll discuss. Have patience, we'll discuss one by one. Okay? Now, let's start. The banking structure, the head of the banking structure in case of India is Reserve Bank of India. What are the important points regarding Reserve Bank of India? Reserve Bank of India was established through recommendation of one of the committees. Remember the name of the committee, Hilton Young Commission. There is one committee even before independence, 1934. Please remember that. Right? Even before independence, Hilton Young Commission gave a recommendation, and based on that, we established Reserve Bank of India, that is RBI, started working from the 1st of April 1935. And right, please remember this, the act under which RBI has been established. I repeat, the act under which RBI has been established is the Reserve Bank of India Act of 1934. Now, based on this information, let me ask you a very simple question. Is RBI a constitutional body in India? At least for those for whom polity is over, this should not be very difficult. Right? Is RBI a constitutional authority? Arey Baba. Some of you saying yes. Right? So dangerous. The reason why I'm saying so dangerous is, I'm saying it has been established through RBI Act of 1934. And those who are answering yes, please tell me what is the meaning of the term constitutional body? Constitutional body means this has to be mentioned in the Constitution of India. There should be an article in the Constitution of India. For example, any example of a constitutional body? Supreme Court, Comptroller Auditor General, CAG, your favorite UPSC. All these are constitutional authorities. There is article for all of them. For Reserve Bank of India, there is no article in the constitution. Why? RBI was established even before independence under the RBI Act of 1934. That is the important point. Please remember this. Next one. Initially, to begin with, Reserve Bank of India. Reserve Bank of India was established in Calcutta. It was established in Calcutta. Then in 1937, it was transferred to Mumbai. Even today, the headquarters of Reserve Bank of India is there in Mumbai. Initially, it was privately owned. Privately owned means what? Government of India did not have the ownership. Private members were there. People invested and they had the ownership of Reserve Bank of India. For example, let me give a very simple example. Reliance Company. Tell me, is the Reliance Company government-owned entity in India? Think of it. Many of you ask, sir, what do you mean by privately owned? Is a Reliance Company a government-owned entity? No. What about Infosys? Is it a government-owned company? Again, no. What about TCS? No. Answer is these are privately owned entities. In the same way, to begin with, RBI, there is a concept of shareholding. Right? Initially, there were shareholders, privately owned entity. But in 1949, Government of India nationalized RBI. Government of India nationalized Reserve Bank of India. Nationalization means what? Ownership was transferred into the hands of the government. Today, if you ask me, who will own RBI today? It is the Government of India who has the complete ownership of Reserve Bank of India. Done? Right? These are certain introductory points. Now, let me focus on the act here. Reserve Bank of India Act, because questions have been asked on this. For example, in one of the years, right, 2 years ago, one of the statement in the UPSC prelims was the Reserve Bank of India's governor, RBI governor, is appointed as per the provisions of Constitution of India. I'll show you that question later. Please don't worry. Question was, the Reserve Bank of India's governor is appointed as per the provisions under the Constitution of India. I already have told you, it is not a constitutional authority. So answer will be no. Right? So that's the reason suddenly UPSC can ask you a question. Now, right, look at it. I'll connect it to some of the sections. I'll connect it to current affairs. For example, section 47. Tell me, was it there in the newspaper very recently? Section 47, was it there in the newspaper? Right, very recently, last week itself. Section 2022, was it being discussed very recently in the context of 2000 rupee currency notes? That is a precise reason lot of these sections are important. Suddenly UPSC can ask you the sections in the civil services preliminary examination. Please be very careful. Now, section 3 talks about establishment of Reserve Bank of India. Section 4 talks about capital. Capital means money. Please understand. Capital means money. How much money will be invested? How much money will be there with RBI? That is called as capital. Section 7. The Government of India can issue a directive to RBI. RBI has to follow it if it is issued under Section 7. I'll repeat the statement here. Section 7, under this, if Government of India will issue a directive, right, issue a direction to RBI, RBI has to follow it. RBI doesn't have any option. RBI has to simply follow it. That is Section 7. Section 8, what is the composition of Central Board of Directors? This was also mentioned in the newspapers. And that was in the context of dividend transfer, surplus transfer. I'll tell you what is the composition. Have patience. Section 17. What should be the function of RBI? For example, I'm pretty sure some of you might have thought, why is RBI not investing in real estate? I hope you understand. Some of you would have thought of this. Why is RBI not investing in real estate? Why is RBI not producing goods and services? Why is RBI not, right, let's say, manufacturing jeans and selling in the market? Why is RBI not manufacturing a bottle in India? For a very simple reason. What is supposed to be done by RBI is strictly limited. I hope you understand the logic here. What is the function of RBI? That will be defined under the section 17 of RBI Act. And beyond that, right, beyond that, RBI is not allowed to do any other activity. Section 21, RBI must conduct the banking affairs of the central government and manage public debt. I'll discuss this also. Have patience. Right, so these are some of the sections I would recommend strongly to all of you. Remember at least the ones which are there in the current affairs. Is the logic okay with all of you? You don't have to remember all the sections. At least remember those sections which are there very often in the discussion in the current affairs. For example, 47 was there very recently. 22 was there very, very recently in the newspaper. Okay, these are some of the sections under RBI Act of 1934. Now, there is one section, please have a look at it. Section 8, which talks about Central Board of Directors. Now, what is the Central Board of Directors? The decision-making authority within the RBI, which is the decision-making authority. Who will make decisions within RBI? It is the Central Board of Directors. Right? It is the Central Board of Directors. And as per the RBI Act of 1934, the maximum number of people within CBD is 21. And this is the breakup of 21 people. Please by heart it. I'll give a very simple explanation to this. This is how I remember. 1, 4, 10, 4, 1. Can I call this as a mirror image? Let me know. Can I call this as a mirror image? Right? 1, 4, 10, 4, 1. Some of you are saying no. Then my dear, you don't even know what is the meaning of the term mirror image. Right? What is visible on this side exactly is visible on the other side. If you have a doubt even now, right, please go stand in front of a mirror. Right? 1, 4, 10, 4, 1. Right? Or mirror image. Only difference is that you will have to add one more on this side. What is this? One is the RBI governor. 4 are deputy governors of RBI. 10 are experts. 4 are representation from 4 local boards. 1 plus 1 from the government. Government in the sense, the secretaries, finance secretary as well as economic affairs secretary. Whoever is the finance secretary by default is a part of Central Board of Directors. And whoever is the economic affairs secretary by default becomes a part of Central Board of Directors. Okay, that is basically 1, 4, 10, 4, 1 plus 1. Okay, that is basically the composition. Now, many of you will do this, right? I know many of you will do this. That is, try to find some loophole with what I'm discussing. You will take the Central Board of Directors, type it in the Google, and Google suddenly says, right now there are 17 members. Right now there are 15 members. Right now there are 18 members. And now you will come to me and say, but sir, you told 21. My dear, my simple question to all of you is simply this. Will there be always a 10 members, right? Always a 10 members in the Central Board of Directors? What if 2 of them are retired? Government is taking time to appoint them. Will there be always 4 deputy governors? What if one of them is retired? Government is taking time, vacancies is there. So possibility is there. So as per the RBI Act, composition must be 21. But of course, from one time to another time, all the 21 may not be present. Some of the vacancies might be there. Okay, now, what is this idea of a local board? Please look at the places where local boards are set up. I hope you understand. Please look at the places where local boards are set up. Historically, are these important or not? Metro cities. Historically, are these important or not? These were the 4 very important places during British government. Mumbai, right? Then it was Calcutta, now it is Kolkata, Chennai, and New Delhi. So we have 4 offices of RBI, very, very important offices in the metros. These are called as local boards. And apart from this, we also have many other RBI offices which are spread throughout India. For example, we have one in Bangalore, we have one in Hyderabad, one in Jaipur is there, one is in Kanpur, etc., etc., etc. Throughout, right, India, the RBI offices have been established. This is the organization structure of Reserve Bank of India. Can I go to the next one here? This is most important. As far as I'm concerned for UPSC examination, this is the most important part that you'll have to remember. Right, so what we have discussed, introductory points when RBI was established, RBI Act, certain sections of RBI Act, then what is the structure of RBI. Now come to the functions of RBI. Now these are the most important functions of RBI. Let's go one by one. Controlling inflation, it is one of the very important functions of RBI. Anybody disagrees with me, let me know. Point number 1, we have discussed this. Controlling inflation, it is one of the very important functions of Reserve Bank of India. Any problem? Can I go to the next one? Printing of currency notes. Let's start with the current affairs. Okay, printing of currency notes. Now, what is this idea of a currency notes? In case of India, please remember this. We have currency notes and we have currency coins. Okay, we have currency notes and we have currency coins. Currency notes are printed, currency coins are minted. Currency notes are printed, currency coins are minted. Printing of currency notes is done by Reserve Bank of India, except 1 rupee note, and the minting of all the coins is done by Government of India. I'll repeat it. Currency notes are printed by RBI, except 1 rupee note, and currency coins are minted by Government of India. And when I say currency notes are printed by Reserve Bank of India, understand the logic behind it. Reserve Bank of India has the right to print and distribute currency notes, but RBI, after taking the approval of the Finance Ministry, I repeat, they will do this after taking the approval of Finance Ministry. Meaning what? Imagine tomorrow RBI governor feels like printing 5,000 rupee note. I hope you understand my point here. Tomorrow RBI governor feels like printing 5,000 rupee note and distributing in the market. Can they do it without taking the approval from the Finance Ministry? Think of it. Does it make sense to you? Can they simply do it? Because, right, RBI has the right to print currency notes. No. First, they will have to prepare a report, send it to the Ministry of Finance. Once the Ministry of Finance gives the approval, now RBI will start printing the currency notes. So, although as per various acts, we say RBI has the right to print currency notes, they don't do it unilaterally. They will take the permission of the government first, then they'll start printing currency notes. So, printing and minting. Point number 2. Right now, the currency notes that we are using, these currency notes are called as Gandhi series notes. These currency notes are referred to as generally Gandhi series notes. Sir, why Gandhi series? If you just open any currency note that you have, 2000 rupee, 500, 200, 100, 50, 10, whatever currency note you have, if you just open it and have a look at it, you will see bust of Mahatma Gandhiji. I repeat, you will see bust of Mahatma Gandhiji. Bust means photo of Mahatma Gandhiji. And this idea of printing Mahatma Gandhiji's photo on the front side, I repeat, on the front side of the currency note, it is called as a Gandhi series notes. Gandhi series notes. And as expected, many people, so then before 1996, have you seen those old currency notes where RBI logo was there? If you have not seen those, please ask your parents. I'm pretty sure either your father or your brother or your uncle or yourself, you would be storing the old currency note. where you will see this logo of Reserve Bank of India in the currency note. Earlier, there was only one pattern. There was not just one pattern. Many currency notes used to carry the logo of RBI. Many currency notes used to carry the farmers carrying, right, let's say the wooden plow. Many currency notes used to carry the satellite images, etc. But post 1996, what we have done is we have made it uniform. We are simply saying all the currency notes which we are printing, all these currency notes will carry the photo of Mahatma Gandhiji on the front side. Hence, these are called as Gandhi series notes. Right? And another point is very important. When you look at the currency notes which are printed and issued, even the coins, generally these are printed and minted in a denomination so as to facilitate easier settlement. I hope you understand this. Right? These currency notes which are printed, coins which are minted, these are printed and minted in a denomination which will help us in settling transactions. For example, have a look at the series here. Don't you think you have coins in the denomination 1 rupee, 2 rupee, 5 rupee? Think of it. 1 rupee, 2 rupee, 5 rupee. Currency notes 10 rupee, 20 rupee, 50 rupee. Right? 100 rupee, 200 rupee and 500 rupee. Now think of it. Why these kind of denominations? Why not a 7 rupee coin? Have you thought of it? Why not a 7 rupee coin? Why not a 33 rupee coin or 33 rupee note? Why not 53 rupees note? Reason is very simple. You take any amount of transaction, you want to settle any amount of a transaction. For settling transaction as well as getting the change, these denominations always will help you. I hope you understand. These denominations will always help you. 1 rupee, 2 rupee, 5 rupee, 10 rupee, 20 rupee, 50 rupee, right? 100 rupee, 200 rupee, 500 rupee. You can easily settle transactions. Rather than this, imagine, right? There were 3 rupee coins, there were 13 rupee coins, there were 27 rupee coins, and you want to make a settlement of, let's say, 55 rupees. Now start doing the circus. I hope you understand, right? Start doing the circus, right? So that's the reason generally this is called as a Renard series, right? Where settlement can be done very, very easily. Okay, that is one more very important point regarding currency notes. Next, where do we print the currency notes? Where do we print currency notes? The currency notes are printed at these 4 places. Again, this can be a question in the prelims now. Why? Thanks to 2000 rupee announcement. The currency notes are printed at these 4 places. That is Devas in Madhya Pradesh, Nasik in Maharashtra, Mysore in Karnataka, and Salbani, which is there in West Bengal. Okay, right? So these are the 4 places where the currency notes are printed, right? These are the 4 places. The first 2 are owned by Government of India. The first 2 are owned by Government of India. That is, Government of India has set up one more company, SPMCIL, and the SPMCIL owns the first 2 printing presses. And right, the next 2 are owned by Reserve Bank of India. Right, Reserve Bank of India owns one more subsidiary, and this subsidiary, Bharatiya Reserve Bank Note Mudran Limited, owns the next 2 printing presses. So these are the 4 printing presses where the currency notes are actually printed in India. Done? Now, right, any problem, let me know. Anybody still has a doubt regarding the 2000 rupee currency note? Let me know right now. Any doubt? The term private limited, please understand, under the Companies Act, the idea is very simple. Public limited, private limited. Public limited means Government of India's ownership. The number of owners, right, it is based on the Companies Act, right? Whether the number of owners are less than 2, more than 2, up to 50, etc., etc. Do not be thrown away by this particular term, private limited. It is as per the Companies Act, right? Don't become a chartered accountant, leave it. That's more than sufficient. Any difficulty? Can I go forward? Why did they ban 2000 rupee currency note? RBI simply said the money that is in the circulation. Right? Again, I expected you people to read newspapers. Right? The 2000 rupee banning, I'll not call it as a banning, I'll call it as a withdrawal. Now understand the logic here. RBI follows a policy called as clean note policy. RBI follows a policy called as clean note policy. What do you mean by clean note policy? The currencies which are there in the market, focus on currency notes. Reason is simple, my dear. The value of the currency notes in circulation is very, very high. Currency coins is just a fraction of value of currency notes. So focus on currency notes. So RBI follows a policy called as a clean note policy. Under the clean note policy, RBI very often will withdraw old currency notes and introduce new currency notes. Is the logic okay with all of you? RBI follows a policy called as a clean note policy from 1999, under which they will withdraw old currency notes and introduce new currency notes. Sir, why do they do that? Reasons could be multiple. One of the reasons could be fake currency notes, counterfeit currency notes are very, very high in the market. Right? One of the reason is this: fake currency notes, counterfeit currency notes are very, very high. And I hope you understand, people who will create counterfeit fake currency notes, they will have a fake of larger denominated currency. People will not create counterfeits of 1 rupee coin, 1 rupee note. No, they will target 500 rupee notes. They will target a 2000 rupee note. They will target 200 rupee note. Why? Higher denomination. Profit for them, although it is illegal, profit for them, it is much higher. So one of the reasons generally cited by RBI is fake currency note. Second one is black money. Second one is the idea of a black money. Simple. People who will store black money, they will store it in different value or different form of assets. And when you store the black money in terms of currency, right, you will try to hold it in a higher denomination currency. Yes or no? For example, imagine. I'm not casting any aspersions on anyone. I'm not doubting anyone here. Imagine you have a black money of 2 crore rupees. Simple question to you. Would you want to hold this 2 crore rupees in the bundles of 2000 rupee note or 1 rupee coin? Apply common sense. Apply common sense. Automatically, you will target a higher denomination currency. So RBI says, what if I simply withdraw the 2000 rupee note in the market, right? Whatever black money you're holding becomes useless. You'll have to come to the bank or else it becomes useless, right? So argument is simple here. Fake currency notes, black money, and the third one is there's a concept called as soiled notes. There's a concept called as soiled notes. What is the idea of a soiled note? Soiled note basically means those currency notes which have incurred lot of wear and tear. Those currency notes which have incurred lot of wear and tear. Wear and tear means what? For example, I'll tell you an example. Imagine you have a 100 rupee note. You will purchase something from the market and the shopkeeper will give you 10 rupee currency note into 4 numbers. 10 rupee denominated into 4 numbers. Now, don't you think most of the times one of those currency notes, one of those 10 rupee notes would have tearing at 10 places, would be torn at 10 places, will have a sellotape in 20 places. Somebody would have written an UPSC essay on the paper. Now you will try to use the 10 rupee, pay somewhere. They will not accept it. They'll simply say, no, I will not accept it. This is a note which is not to be accepted in the market now. So that is basically called as a soiled currency notes. Right? So there are various reasons for which purposes RBI follows a concept called as a clean note policy. And RBI says it is under the clean note policy that we are withdrawing, not banning. We are withdrawing, right, the 2000 rupee currency notes. Right? This is the logic which has been given by RBI. Okay, done. And it makes, to a certain extent, it makes sense. Most of you can counter argue to this. Most of you say, but. You'll have so many arguments, counter arguments, just like I discussed. But argument is simple here. If you look at the situation of money circulation in India, right, currency circulation in India, RBI has a proof. RBI shows that in recent times, the 100 rupee note circulation has increased. 200 rupee currency note, we have introduced more and more. 500 rupee currency note, we have introduced more and more. And people are using these kind of currencies to conduct transactions. And generally, I'm pretty sure all of you would, or at least some of you would have experienced it. You have taken a 2000 rupee currency note, go to the market, you will purchase something, shopkeeper will say, I don't have any change. Yes or no? Right? You will take a 2000 rupee currency note, you will purchase something, shopkeeper says, I don't have any change. Right? Why? Earlier we had 1000 rupee currency note, this was a demonetized. Now when you purchase something in the shop, let's say 50 rupees worth, 200 rupees worth or 300 rupees worth, the shopkeeper has to have 500 rupee currency notes. Right? That is basically the issue here. Right? So that is the reason RBI cited all of these and stated, okay, right, people are using more and more lower denominated currency. No point in having 2000 rupee currency circulated in the market. And it is also very, very small value out of the total currencies in the market. Let's withdraw it. That is basically the argument that has been put forward by Reserve Bank of India. Okay, this is the discussion regarding the concept of the currencies in India. Any problem? Can I go forward? Currencies regarding India. Any problem? Can I go to the next point? What is a soiled note? Soiled note means the currency note which is unfit to get circulated. You cannot circulate it again in the market. That is basically soiled note. Fake notes again. What do you want me to discuss in fake notes? You tell me. What do you want me to discuss in fake note? Fake note is a problem. Right? If you want to understand, again, not compulsory for UPSC. Right? At least tell me, do you people have the habit of watching web series or not? Web series. Very recently, there is a web series on fake currency notes in India. Farzi. Have you seen it? If not, again, don't start watching it now. If you're not interested, leave it. UPSC will not ask you that. Okay, let's start. The next important function of Reserve Bank of India, banker to the government. Okay, right? So banker to the government. Banker to the government, right? What is this idea of a banker to government? Banker to the government simply means providing loans to the government. Providing loans to the government. RBI will provide loans, but please understand, rather than directly providing loans, RBI will help Government of India. I repeat, RBI will help Government of India to borrow, to take loans from the market. How? I'll explain it. Follow this discussion very carefully. Point number one, let's go point by point. All of you know that every year, Government of India's expenditure will be more than income. Anybody who says otherwise, let me know. Every year, Government of India's expenditure is more than its income. They spend more than what they earn. Point number two, if they are spending more than what they are earning, if I want to give it in terms of numbers, if they are spending, let's say 100 rupees, they are earning only 80 rupees. How is that possible to spend 100 with only 80 rupees? It's not possible, which means government will borrow from the market. Government borrows from the market. Done? Point number three. Okay, point number three. Some of you are using a technical term. I'll not use it. It could be a revision for you, or you already have read. Right? So that deficit, this deficit. Others, don't worry. Let's start. Now, point number three. When I say government will borrow, the borrowing can be from the domestic market, can be from outside market as well. Can be from domestic market, can be from external market as well. So domestic market, how does Government of India borrow? I'll introduce one more friend of yours. Do you remember this piece of paper? Let me know. Do you remember this piece of paper? Right, day for yesterday, we had used this piece of paper. And I said, this piece of paper is nothing but an example of a bond. What is a bond? Bond is a debt instrument. Bond is nothing but a debt instrument. Debt instruments are used for what? Debt instruments are used for borrowing purposes. Now, please look at this. Can I say one of the important sources of domestic borrowing for the government can be government will issue bonds in the market and borrow. Any problem with this? One source. Government will issue bonds from the market and borrow. And whenever government will borrow from the domestic market, I'll refer to this as internal debt. I'll repeat it. Because government is borrowing from the internal sources, I'll refer to this as internal debt. And on the other hand, external borrowings. Does government borrow from external sources? Of course, yes. Government may borrow from World Bank. Yes or no? Government may borrow from World Bank. Government may borrow from, let's say, International Monetary Fund, IMF, etc. Now, because government will borrow from external market like this, can I call this as external debt of the government? External debt of the government. Any problem? Can I go to the next point? Any problem so far? Can I go to the next point here? So government will borrow from the market. The borrowing, right, will be either from the domestic sources or from external sources. External sources, they can borrow from another country. They can borrow from World Bank. They can borrow from IMF. There are different sources. But what is the logic there? Logic is borrowing is done by the government, but the amount is coming from outside India. Outside India. And because the borrowing is coming from outside India, government has to repay it. I'll call this as external debt. And on the other hand, government, I said, can also borrow from the domestic market. That is within India, government can borrow. And have a look at this. I said one of the sources, one of the ways through which government can borrow from the domestic sources is by issuing instruments which are called as bonds. Right? Bonds. And because government is borrowing from the domestic market, I'll call this as internal debt. Right? These are the three very important points. Let me go to the fourth very important point. Government issues various securities in the market. Securities in the market for securities in market for borrowing purposes. For borrowing purposes. Okay. Now these kind of securities or these kind of instruments are of two types. The government securities are called as treasury bills, and the government securities are also referred to as another classification, dated securities. Now you will ask me, sir, what is the basic difference between a treasury bill and a government, right, the dated securities? Now please have a look at the piece of paper that I'm holding in my hand. Please have a look at it. If I say this is a treasury bill, what is the meaning of it? It means I will issue the treasury bill to you. I will borrow money from you for less than 1 year. Let me know. Please do let me know. I'll repeat it again. I will issue this piece of paper to you. I will borrow money from you for a period less than 1 year. Less than 1 year could be 91 days. It could be 182 days. It could be for 364 days. Because it is for a shorter term, up to 1 year, less than 1 year, these are called as treasury bills. Any problem here? Can I go to the next one here? Any problem regarding treasury bills? Now, second, dated securities. What is the idea of dated securities? Same. I will issue this to you. I will borrow money from you for 2 years. I'll borrow money from you for 5 years, 3 years, 10 years, 40 years. Can I say long term? In the first example, I borrowed for a short term. Now I'm borrowing for long term. So whenever you borrow for a longer duration, these instruments are called as dated securities. These are called as dated securities. So one type of instruments issued, right? One type of instrument that is issued is called as a dated security, but it is for longer term. Another type of security issued is for a very short term, up to 1 year. That is basically treasury bills, right? So treasury dated securities. Now, is it only government of India that borrows like this? Is it only the government of India that borrows like this? Of course, no. Are you people reading about what is happening in USA? This is where you need to connect current affairs, my dear. Are you people reading what is happening about USA? What is happening in case of USA? Government wants to borrow. Sir, I don't read any other newspaper. I read only, right, Hindu. Open Hindu. Please read about this. This is there every day in the newspaper. Almost every day in the newspaper. Government wants to borrow in USA. I hope you understand. Government in USA wants to borrow. But for the government to borrow, they need permission from the Congress in USA. Is the logic okay with all of you? Right? Government wants to borrow, and for borrowing, they need permission from Congress. And that is basically the discussion. Right? So again, even in USA, they issue, right, the government securities. Right? It is a very, very common phenomenon. Government issuing securities to borrow from the market is a very common phenomenon. Across the globe, governments do this. Right? So government borrowing can be done for a short term, can be done for long term as well. Now, point number 2 within this slide. Dated securities. Dated securities are also referred to as government bonds. I'll repeat the statement here. Dated securities are also referred to as government bonds. Now, many of you ask me, sir, why only dated securities? You have written government bonds. What about treasury bills? Can I call treasury bill as a bond? No. Understand the reason very carefully here. Whenever you use the term bond, it simply means the tenure of the bond or tenure of the instrument is more than 1 year. I'll repeat the statement. Whenever you use the term bond, what is generally represents is the tenure of the bond. That is the time period, maturity period of this instrument is more than 1 year. Now, please have a look at the picture and tell me, do the treasury bills have a maturity period of more than 1 year? Is the tenure of the treasury bills more than 1 year? Of course, no. That's the reason dated securities are also referred to as government bonds. So government wants to borrow. They can borrow from the domestic market. They can borrow from the international market. I'm focused on the domestic market here. And when they want to borrow from the domestic market, one way they can borrow is they can issue bonds, they can issue treasury bills, and they can borrow from the market. Now, how do they borrow? What is the role of RBI in all of this? How do they borrow? What is the role of RBI in all of this? Let me explain it to you. Follow this very carefully. Some of you will get confused. That's the reason. Please follow the discussion. Here is the government of India. Imagine they want to issue this bond in the market. I'll repeat. Government of India, they want to issue this bond in the market. Now, they will not directly go to the market and start selling the bond. No, they will not do that. They will basically give this bond to Reserve Bank of India. I repeat, they'll basically give this bond to Reserve Bank of India. and it is the Reserve Bank of India which will sell these bonds, or else you can also use the term auction these bonds, collect the money and transfer it into the account of Government of India. Any problem with the supply here, or any problem with the supply chain or the sequence? Let me know. I'll repeat it. Government of India wants to sell this bond. Government will not directly sell it because government doesn't have all of this expertise, right? I hope you understand why. How many of you believe Government of India has people who will take these bonds, go to the market, sell, bring money, give it to the government? No, that is not how government has people, or that is not how government functions. Government is in the business of implementing policies, making policies, etc. So what government does is, government knows RBI is owned by them. So government will simply give this bond to RBI. RBI will auction it, sell it in the market, collect the money, transfer it into the account of Government of India. This is how RBI plays a very important role. I repeat, RBI plays a very important role in helping Government of India collect money or borrow money from the market. Collect or borrow money from market. Now, many of you are asking, sir, if RBI is selling these bonds, who will purchase these bonds? Understand the next point carefully. Individuals can purchase it, such as you and me, right? You are allowed to purchase this bond. I am also allowed to purchase the government bond. The banks will purchase them. Foreign investors will purchase them, etc. So there is a huge number of buyers to purchase government bonds. And please remember this, government bonds are also referred to as government bonds, or government securities are also referred to as gilt securities. They're also referred to as gilt securities. And before you start correcting me, it is not GILT. Spelling is correct, GILT, gilt securities, GILT, gilt securities. These are also referred as gilt securities. And another very important feature associated with gilt securities is the safety of investment is very high. Safety of investment is very high. Anybody has a problem? Sir, why there is a very high safety of investment here? Then my answer to you will be, please see who is issuing these bonds. Please check who is issuing these bonds. Government is issuing these bonds. You tell me anybody is more secure to lend in the market than Government of India. Think of it, right? Can you tell me anybody who is right willing to borrow, but he is much more credible than Government of India? Of course, no. So Government of India is issuing these bonds, or the state governments are issuing these bonds, right? Basically, the safety, right, or security is very, very high. That is very, very important point. Remember this. Now, any problem with any of these points that I've discussed? Any problem with any of these points that I've discussed here? Next point is very important. They can cheat. Who can cheat here? But no assured interest. My dear, government will assure interest. Government will assure interest. Government is issuing this bond means who is guaranteeing interest to you? Who is guaranteeing interest to you? Obviously, government is assuring interest. Okay. Sir, if I purchase, what will I get in return? My dear, please have a look at it. What will you get in return if you purchase this bond? Let me know. I'm holding a bond in my hand, right? Hypothetical example. What is the interest you are going to get? 8% every year. And who is going to give you this? Government of India. Tell me one example where Government of India has not paid money to the creditor. You tell me. Can you see any examples in the past where Government of India has borrowed and has not repaid money? There are no examples. Don't waste your time. That's the reason I said safety of investment is very, very high. Very, very high here. Okay. Now, next important point. When I say RBI will auction it, RBI will sell it, right? What is the basic idea here? There are two very important points. Understand this very carefully. RBI will auction the G securities, will sell the G securities, right, to the investors in the market and collect money, give the money to Government of India. This is one point that we have discussed so far. Point 2, when I say RBI will auction, sell this particular G securities to the investors, how? What is the method through which they will sell it? RBI has a website or a portal by the name of eKuber. Very, very famous. RBI has a website or a portal by the name of eKuber, Electronic Kuber. It's a name of the website. And through the eKuber, RBI will simply sell or auction the G securities. Will sell and auction the G securities in the market. That is how RBI will sell, collect money and transfer the money into the account of Government of India. Now, second very important point I want to discuss is, follow this very, very carefully. Government of India, whenever they sell government securities, RBI is not allowed to purchase the government securities directly from Government of India. I'll repeat it, right? And understand this statement carefully. When Government of India will sell the G securities, RBI is not allowed to purchase the G securities directly from Government of India. Can RBI purchase it indirectly from anybody else in the market? Can RBI purchase G securities apart from Government of India from anybody else in the market? It is allowed. It is allowed. I will tell you why. Right? I'll write it here. Here is Government of India. G security, right? RBI, Reserve Bank of India. RBI will pay money. Is this allowed? No. This is not allowed. This is not allowed. Why? I'll explain it. Have patience. Second, right, within this, second, imagine I am holding certain G security. Here is me. I am holding this particular bond of Government of India. Can I sell this G security to RBI? Can I sell this G security to RBI? Can RBI purchase this G security? Yes, it is allowed. This one is allowed. Don't say both are one and the same. I hope you understand. Don't say both are one and the same. Understand the difference between both. In the case 1, I'm talking about this. In the case 1, if RBI purchases the G security directly from Government of India, please tell me what will happen to money supply in the market. Let me know. Example 1, case 1 I'm talking about. If RBI directly purchases G security from the Government of India, tell me what will happen to money supply in the economy. Or money supply increases, my dear. Money supply increases in the market. You're saying decreases in the market. How? You are the Prime Minister. Let's start. This is basic idea. You should not have any doubts here. You're the Prime Minister. You have 100 rupee bond. I am RBI Governor. Of course, right? Hypothetically. I am the RBI Governor. I will purchase the bond from you. I will give you 100 rupees. Now you tell me, what will you do with 100 rupees? You will spend money. You will spend on this, that, etc. This 100 rupee which was not there in the supply earlier, RBI had kept this 100 rupee, and I hope you understand. RBI will not purchase goods and services from the market. RBI has this 100 rupee printed. They will give it to you. You will give the bond to RBI. Will the money supply in the economy increase or not? Of course, yes. And can that cause inflation in the market? Of course, yes. That's the reason this is not allowed. This, right, first one is not allowed. But on the other hand, right, RBI, can they purchase the bonds from me? Can they purchase from you? Can they purchase from anybody else? Of course, yes, it will be allowed. Right, that is basically the concept of RBI intervening in the market. And please understand, RBI can sell the bond which are already there with RBI. RBI can also purchase the bond which are there in the market. That is one tool. Understand this? There is a tool called as open market operations. OMO, open market operation. What is this idea of open market operation? Under open market operation, RBI either sells or purchases G securities from market either to promote growth or control inflation For example, let me give you a very simple example. Imagine today inflation rate is very high. Can I say one of the ways through which RBI can control inflation is by selling G securities in the market? Let me know. One of the ways through which RBI can control the inflation in the market is by selling G securities in the market. Right? Idea is very simple. Inflation high means people have lot of money. So what RBI will do? RBI will sell G securities and take away money from the market. And on the other hand, imagine RBI wants to promote growth. And when RBI wants to promote growth, right, what will RBI do? RBI, imagine last week has purchased certain G securities. They will sell these G securities so that the money supply in the market increases. Any difficulty in understanding this? Any difficulty? Let me know. So on one side, to promote growth, RBI will increase money supply by purchasing G securities from the market, not from government, from the market. And on the other hand, RBI, not to control inflation, will sell G securities to reduce the money supply from the market. This is basically the concept of open market operation. OMO, open market operation. Okay. Now, with all of this information, what is the need? Why should you understand all of it? I'm adding one point after one point regarding RBI's functioning. Please understand them. We have discussed the concept of bonds day for yesterday. Let me revise it. Bonds are nothing but debt instruments. Where the holder of the bonds will receive certain payment. For example, imagine this is a bond. Okay, imagine this is a bond. Government has issued the bond. You have purchased this bond. And let's say the maturity period of the bond, that is the tenure of the bond, is 5 years. What is the meaning of it? Today you will purchase the bond. Government will collect 100 rupees from you. And every year, government will give you 8% rate of interest. Any problem with the explanation here? Every year for the next 5 years, government will give you 8% rate of interest. And after the maturity period is over, that is the tenure of the bond is over, government will simply give back the principal amount to you. That is how the bonds generally work. Now there is a technical term here. The 8% I used rate of interest. I said rate of interest. But in the context of the bonds, please remember the term used is coupon. I repeat, the 8%, I said it is a rate of interest. But when you're talking about a bond, rather than rate of interest, they will simply use the term coupon rate. Can I simply say this bond has a coupon rate of 8%? Let me know. Can I simply say this bond carries a coupon rate of 8%? That is another very important point. Now, third very important point, there is a term called as face value. Right? This one is same, what I've explained to you so far now. Government or company will sell the bond. Investor will pay the money to the government or the company, whoever is issuing it. Step 2 is government or company will repay the money and investor will return the bond after the maturity period is over. Annually, the interest or the coupon is paid. Now, let me introduce one more technical term to you. Please have a look at this piece of paper. Assume this is a bond. Tell me, there is a number written in the form of rupees on the bond or not? Let me know. is there a number written in the form of rupees, values on the bond? Answer is yes. How much? 100 rupee. That is called as a face value. That is called as, or that is referred to as face value. And always remember this, in most cases, there are exceptions, don't worry about it. Most cases, the coupon rate is always given on face value. Is the logic okay? The coupon that is given, it is always on face value. Meaning what? Imagine you will purchase this bond from the government. Tell me how much will be the coupon that you will receive. Think of it. How much coupon you will receive? 8 rupees. All of you will agree? Any problem with this? 8 rupees. Now you will sell it to me. Understand the next point. You will sell it to me. I am the owner of this bond now. Tell me how much coupon I will receive. Right? You have sold this particular bond to me. I am the owner of the bond. How much coupon I will receive? Same number. Any problem here? Coupon, my dear. Coupon. Focus on the term coupon. Can you understand the term coupon? Interest. Right? After discussing the whole story, you will commit the same mistake. Coupon, interest. If you sell this bond after 1 year to me, imagine 5-year maturity is there. After 1 year, you will sell it to me. How much coupon I will get? Same, 8% of 100 rupee. Any problem with this? I will sell it to somebody else in the market. Tell me, that fellow will receive how much coupon after, let's say, 3rd year? Same, 8 rupees. Any problem with this? Face value, coupon rate, coupon amount is always fixed. Now, right, let me introduce a complication here. You have discussed now concept of coupon rate. Let me introduce one more term, yield rate. Let me introduce one more term, yield rate. Concept of yield rate. Now, what is this idea of a yield rate? Let me start with a very simple example. Don't worry about bond. Let me start with a very simple example. Imagine there is 1 kg of onion. Imagine there is 1 kg of onion. I will sell it to you, let's say at 100 rupees. I will sell the onion to you at 100 rupees. You will purchase this 1 kg of onion. You want to sell this 1 kg of onion in the market. Simple question to you. Any guarantee what price you will receive from the market? Let me know. Any guarantee at what price you will receive, right, for this onion in the market? Can I simply say, the price that you will receive in the market is dependent on supply and demand? Let me know. The price that you receive depends upon, right, supply as well as demand. That is, you will purchase this onion. By the time you take the onion to the market, what if the supply of the onion is very high? Let me know. What if the supply of the onion is very high? Will you get 100 rupees in the market? No, the price will fall down. And second example, you will take the onion from me, you will go to the market. By the time you reach the market, the demand is very high. In that case, can I simply say you will receive more than 100 rupees? Is the logic okay with all of you? That is, prices of the onion in this case is dependent on supply and demand. Now, remove onion. Replace that with bond. Because just like onion that I gave an example here, bonds are also sold in the market. Bonds are also purchased in the market. That is, I'll simply say bonds are tradable. Any difficulty? Bonds are tradable in the market. What do you mean by tradable in the market? I will sell this bond to you. You can sell it to anybody else. Right? I will purchase this bond from someone else in the market. Which means you can purchase the bond, you can sell the bonds in the market. Now let me know, when you can sell and purchase the bonds in the market, will the market price of the bond remain same? Think of it. Will the market price of the bond remain only one price always? No. You might have purchased this bond. Don't worry about face value. You might have purchased this particular bond at, let's say, 102 rupees. Now you want to sell this bond in the market. There's a very high demand for this bond. Will you sell it at 102? Think of it. You paid 102 and you want to sell it in the market. Demand is very high. Will you sell it at 102? If you say yes, don't trade. You're a very, very bad investor. Demand is very high. You will sell it at 107 rupees, 108 rupees, 109 rupees. On the other side, you paid, right, let's say 103 rupees for this bond. You want to sell it in the market now, and there are a lot of other sellers of the bond. Everybody wants to sell the bond in the market. And I'll tell you why this will happen. The bond in the market. Now tell me, will you demand more than 103 rupees for the bond? Will anybody purchase at 103? That's the point. No. They will purchase it at, let's say, 100 rupees. They'll purchase it at 93 rupees. They'll purchase it at 94 rupees. It will be much lower than 103. Now, any problem here in understanding the fact that market prices of the bonds will keep on changing? So point number one, right? I'll put everything in a nutshell here. Understand this carefully. Point number one, whether you are purchasing this bond or I am purchasing this bond, the coupon amount is fixed. Any problem with statement one? Statement one, whether you are purchasing, I am purchasing, right? I will sell it to somebody, doesn't matter. The coupon amount on this bond is fixed. That is 8 rupees. Point number two, the bonds are tradable. You can purchase, you can sell. In certain situations, supply is very high, market price will go down. In certain situations, demand is very high, market price will go up. Now think of this. You purchased this bond. You purchased this bond not at 100 rupees as written here. You'll purchase this bond at 95 rupees. You purchase this bond at 95. What is the coupon rate? Look at it. What is the coupon rate? 8%. Coupon rate. Coupon amount is 8 rupee. Coupon rate is 8%. What is your returns? Let me know. What is your returns? Your coupon rate is 8%. You will get 8 rupees. But how much is your investment? My dear, follow this very carefully. Most of you are making a mistake. Follow it carefully. Right? You are earning 8 rupees. How much is your investment? 95 rupees. Can you use calculator and find out what is 8 divided by 95? I hope you understand. What is 8 divided by 95? I'll tell you the answer. Don't do it. It will be more than 8%. It will be somewhere around 8.5%. It will be somewhere around 8.5%. Now this is called as yield. This is called as yield. Now look at my statement, listen to my statement and let me know, can the yield rate keep on changing? Think of it. Can the yield rate keep on changing? Answer is yes. Yield rate, some of you are saying no. Yes, the yield rate will change. Coupon rate is fixed. It is printed here. They will give you 8%. But the yield rate will change. Why? Whatever we've discussed just now, can I say market prices will keep on changing? Market prices will keep on changing. Right? That is, let's say a very simple example. Today you will purchase one bond. Follow this carefully. Today you will purchase this bond. And the price of this bond is 95. Okay, you'll purchase this bond. Price of this bond is 95. And right after 1 year is over, you will get how much? 8 rupees coupon. 8 rupees coupon. Tomorrow, you'll purchase one more bond. Similar, one more bond you will purchase. but the market price tomorrow is 93 rupees. Tomorrow the market price is 93 rupees. You will still get the same coupon amount, 8 rupees. Now please tell me, when the market prices has gone down, what will happen to yield rate? Is it possible or not? Does it make sense to you? Because from day to day basis, right, the market prices will change. And when the market prices will change, how much you have invested, how much money you have paid to purchase a bond, it will also change. So now is it okay if I say, if the market prices of the bond will go down? I'll repeat. If the market prices of the bond goes down, yield rate will go up. Let me know. If the market prices of the bonds will go down, yield rate will go up. And can I also add one more statement here? If the market prices of the bonds will go up, yield rate will go down. Right? That is basically 8 upon 92. You will get it somewhere around 8.5%. I'm rounding off. You'll get somewhere around 8.5%. And 8 upon 93, you will get it somewhere around 8.7%. So when the market price of the bond has gone down, yield rate goes up. And when the market prices of the bonds will go up, yield rate will go down. In a nutshell, do not by heart calculations. UPSC will not ask you. In a nutshell, can I write it like this? Have a look at this. Can I write the third statement? In a nutshell, right, is the third statement correct with all of you? Right, let me know. Is the third statement okay with all of you? That is, the market prices of the bonds are inversely proportional to the yield rate. Market prices will go up, yield rate will go down, and the market prices are going down, yield rate will go up. And some of you are saying, sir, I'll get the same amount. My dear, I'm not talking about amount. Understand. I'm not talking about amount. I'm talking about percentage returns. Right? What would you prefer? Right? If your argument is, sir, I'll get the same amount, then I'll give you two examples. Give me 100 rupee loan, I'll give you 8 rupee interest. Give me 1 lakh rupee loan, I will give you 8 rupee interest. As per your calculation, you are making same amount of earnings in both the cases. At least think of it now. At least think of it. Right? You will give a 100 rupee loan, I'll give you 8 rupee interest. And give me 1 lakh rupee loan, I'll give you 8 rupee interest. Right? You think you're making same amount of earnings in both the cases. Even now, if you say yes, then please don't enter into market. Percentage. Have you heard of it? Percentage. How much is your percentage returns here will be much higher compared to percentage returns here. That is exactly what I'm doing. That is, the market prices will keep on changing. Market prices will keep on changing. You only told me, you only agreed. Yes, sir, market prices will change. When the market prices will change, how much you pay to purchase the bond will also change. On one bond, you can pay 95, you will get 8 rupee. In another bond, you will pay 100 rupee, you will get 8 rupee. Another bond, you will pay 105 rupees, you will get 8 rupee. You should not focus on 8 rupee. Focus on your investment as well. Right? So when the market prices will keep on changing, yield rates, percentage returns will also keep on changing. That is basically the third statement. Any problem even now? Any problem even now? Can I go forward? That is, right, we'll take a break. Any problem with whatever we have discussed so far, please do let me know. Okay, so bonds are tradable in the market. We have established that. The market prices of the bonds will also vary. Again, before I take a break, I just want to tell you one point here. Many of you are asking how the market prices will vary. Let me ask you a very simple question. Imagine there is a recession that could happen in the market. Recession. Now you tell me, will you prefer to invest in government bonds or not? Let me know. Right? Imagine private sector companies are incurring losses. there is a possibility of recession. At this point of time, will you prefer to invest in the government bonds or not? Your answer should be yes, by the way. What is your argument? I don't know, but your answer should be yes. Why? Rather than investing anywhere in the market, don't you think it is much safer to invest with Government of India? Right? We have discussed all of this. In fact, I've told you, government as a borrower, one of the safest investments that you can do. Right? So I'm saying there is a probability of recession in the market. You want to invest. Will you invest in the private sector bond? No. Can you purchase shares in the market? Very risky. So now, if all of you will start purchasing government bonds, you tell me what will happen to demand for bonds. Let me know. If all of us start to demand government bonds because it is safer to invest in government bonds, demand will increase. And if the demand will increase, what will happen to the market prices? Market prices automatically has to increase. Any problem with this? Any problem with the idea? Sir, any case where the market prices will fall? Of course, yes. Imagine, right? Imagine now you will realize that you're a foreign investor. It is better to invest in, let's say, UK's market. It is better to purchase bonds of, right, government of Germany. You're a foreign investor. Now, when you're a foreign investor, you will realize that you can earn more returns outside India. Don't you think selling of government bonds will increase in India? Probability is there or not? Or else market is doing very well. Right? Investment in the stock market, every company is doing very well. So because it's a private sector company, they are doing very well, market is doing very well. You people will prefer to invest in the stock market rather than government bonds. Because in the stock market, because the market is doing very well, you will earn more profit. Now, what will happen in the flip side? You will start selling government bonds. And when you start selling government bonds, what will happen to the market prices? Supply will increase, market prices will go down. Right? So whenever market prices of the bonds will go down, yield rate will go up. And whenever the market prices of the bonds will go up, yield rate will fall down. Now, even after this, if it is not understandable to you, simply by heart this statement. Trust me when I say this, unless your optionals is economics, no book will give you so much of explanation because it is not required. But I cannot directly say market prices are inversely related to yield rate and go forward, right? You'll basically start bombarding me with questions. That is the only reason I've given you explanation. I've given you certain calculations. If it is not understandable to you, leave it. Simply by heart this statement. Done? So let's take a break. But before that, any questions that you people have, let me know. How RBI purchases government securities and sells? Have extra money to use its own, right? RBI has a lot of money. I'll show you the balance sheet of RBI. Have patience. LIBOR system. LIBOR, I'll discuss that later. Again, it is not at all relevant for UPSC, but anyways. What is cashier? What if cashier denies to change the soiled notes in the bank? You tell me any example where cashier has said they will not accept your currency notes. Tell me now. Any example where can you see where you have experienced a situation wherein you have taken an old currency note and you want to get it exchanged with the bank? Bank says will not do it. If you have experienced it, there is a complaint redressal system with RBI. There is a complaint redressal system. There is a grievance redressal mechanism with RBI. File a complaint. They will take up your complaint. But they are not supposed to do that. They are not supposed to do that. I've been a manager in a bank, so I know that they are not supposed to do that. They are not allowed to do that. Okay. What is a cash? Okay. How had RBI confirmed that it will not be used after September? RBI, again, that's a very gray area. RBI so far has not given any clear intimation, right? Any clear intimation what is going to happen after September. You'll have to wait and see what they're going to do. Okay. What is Renard series? Renard series basically refers to certain sequence in numbers. For example, 1 to 5, it is called as a Renard series. 10 rupees, 20 rupees, 50, right? 10, 20, 50, Renard series. 100, 200, 500, Renard series. And currency notes that are issued are in the Renard series in India. Okay. Yield rates in simple terms. Arey Baba, yield rates is basically the percentage returns. It is there in the slide. You people don't look at it. That's a problem. It is already there in the slide, but even then, right? Simply will keep on typing. What is the returns generated by an instrument? That is called as yield. Right? 8 rupee is your returns divided by your investment. Let's say 95. That's your yield. Your investment is 100. That's your yield. Your investment is 102. That's your yield. Okay. Any other questions? Means market price increases but returns is fixed. That's a circus I did. That's a whole circus that I did in front of you. I showed you a piece of paper. I asked you how much is the coupon rate. I asked you if you have how much money you will get. If I have how much money you will get. Right? If I sell it to my friend, how much money they will get. Listen to the lecture carefully. Now. Please listen to the lecture carefully. How purchasing government securities from Government of India by RBI increases money supply. My dear, if RBI, right, I hope you understand. So far, I've never told you RBI will be involved in the market to purchase goods and services. I've never told RBI will manufacture goods. Nothing of that sort. RBI, let's say, has printed 100 rupee. It is not there in the market. It is there with RBI. And I hope you understand the difference of having 100 rupees with RBI and with you. If you have this 100 rupee, can I simply say it can get circulated in the market? Let me know. If you have this 100 rupee, can you circulate in the market or not? You can take it, put it in the bank. You can take it, purchase goods and services. Again, it will be given to somebody else. Will it get circulated? Of course, yes. It is there with RBI. Does it mean it is getting circulated? Think of it. It is there with RBI. Does RBI go to the market, start purchasing goods and services? No. RBI will keep it with itself. But on the other hand, if Government of India will print a G security, RBI will purchase the G security directly from the government, gives 100 rupee to Government of India. Will it not increase money supply? Will it not increase money supply in the market by 100 rupee? That is exactly the concern, right? That could lead to inflation. Okay, done. So let me take a pause now. I'll restart at 7:20. I'll restart at 7:20. Join back at 7:20. Okay, welcome back. Am I audible? Can we start? Am I audible? Let me know. Can we start now? Done. Let's start. So we are discussing the functions of RBI. I'm still in the second function. I'm still in the second function only. Let me add a current affairs point here. There's a concept called as operation twist. There's this concept called as operation twist. Very, very famous in the last 2 years. Now RBI is not doing it. And I'll tell you why. But understand what is this concept of operation twist. Point number one. Under the idea of operation twist, Reserve Bank of India, it's basically open market operations. Done. Point number one. It is basically open market operation. OMO. Now, what does RBI do under open market operations? RBI sells G securities. RBI purchases G securities, not from government but from the market. Now, under the operation twist, what is the specialty? Point number one. RBI simultaneously, I think it is given here, RBI simultaneously will purchase and sell the G securities in the market. Follow this very carefully. Listen to the discussion carefully. RBI simultaneously will sell and buy G securities. Now, some of you will be thinking, sir, why? Why RBI will simultaneously sell and purchase G securities? Think of it very carefully now. Imagine inflation is very high. Imagine inflation is high. Now, when you say inflation is higher, what does it indicate? Money supply in the market is also very high. Now, when the money supply in the market is very high, inflation is very high, RBI wants to promote growth. RBI, what they want to do? RBI wants to promote growth. Now, tell me, when RBI wants to promote growth, what they should do? They should increase money supply. Increase money supply. But look at the problem now. Please look at the problem. RBI wants to promote growth. They want to increase money supply. Inflation is already high. If RBI simply purchases G securities on the market, RBI should purchase G securities. But if RBI will purchase G securities, what will happen to money supply in the market? Money supply will further increase. If money supply further increases in the market, what will happen to inflation? What will happen to inflation? Inflation will also start increasing. So don't you think RBI, right, is creating one more problem in order to promote growth? They can promote growth, but the problem is there is one more problem, right? And the RBI is making it much more worse. Inflation will be very high. Now, what to do then? What should be done by RBI? RBI should promote growth. Inflation is very high. Follow this very carefully. RBI simultaneously, I'll take a simple number, hypothetical number, will purchase a G securities worth 50,000 crore rupees and sell G securities worth 50,000 crore rupees. Go point by point. Don't jump and say why. Go point by point. RBI simultaneously, that is at the same time, sell G securities worth 50,000 crore, purchase G securities worth 50,000 crore. Simple question to all of you. When RBI will do this, will the money supply change in the economy? Will money supply change in the economy? Money supply will not change. So with this, now is it okay? Is it fair to say there is no danger of increasing inflation? If RBI will simultaneously, that is same time, sell and purchase, let's say 50,000 crore worth of bonds, inflation will not be caused. But now the question is, why, sir? Why is RBI simultaneously selling and purchasing? It doesn't make any sense. It makes perfect sense. It's a very beautiful concept. Follow this. On one side, when RBI will sell G securities. These are short-term G securities. Short-term G securities. And when RBI will purchase G securities, these are long-term G securities. Specifically, the G security that we will target is 10-year G security. 10-year government bond. 10-year government bond. And why this 10-year government bond is so important? 10-year government bond is considered as a standard in the market. Is the logic okay? I'll repeat it again. 10-year government bond is considered as a standard in the market, a benchmark in the market. And whatever is the yield rate for the 10-year government bond, it will influence interest rates in the market. Let me give a very simple example. Imagine you go to the market, have a look at this. Imagine you have 100 rupee, you go to the market, you want to invest in the market. Now, government bond is there. On the government bond, you are getting a yield rate of 9%. On a government bond, you are getting a yield rate of 9%. And I will come to you, I'm a company, I will offer a bond to you, and I'll say, I will give you a coupon rate of 8%. Will you purchase the bond from me? Think of it. Will you purchase the bond from me? You'll not simply purchase it. Why? You'll simply say, if I purchase a government bond, I will get 9%. Now, what if government bonds, that is again 10-year G security bond, the yield rate will fall down to, let's say, 8.1%. Will fall down to 8.1%. Now, I'll come to you. I will offer a bond to you, and I will say, rather than 8%, I will give you 8.5%. Will you now think of purchasing my bond? Think. Again, you may purchase or not purchase, because again, apart from the coupon, apart from the interest, there is also safety. At least, am I competitive now? Am I competitive? Now, what if this yield rate on the 10-year government security will increase it to 8.6%? Can I sell a bond with a coupon rate of 8.5%? No. I will have to increase it to, let's say, 8.8%. Now, I'll give a statement. Tell me whether this makes sense or not. The yield rate of 10-year G security, will influence interest rates in the market. Any problem here? Any problem? So as the yield rate of 10-year government security will keep on changing, interest rates in the market, that is at what rate of interest others will borrow, others will lend, will also keep on changing. Now you tell me, if you are RBI governor, you want to promote growth. You are the RBI governor. You want to promote growth. What should be the interest rates in the market? Let me know. If you are the RBI governor, you want to promote growth, what should be interest rates? Should the interest rates be lower? Should the interest rates be higher? Interest rates in the market should be lower. Interest rates should come down. Some of you are saying hi, my dear. Right? Again, this is mostly puzzling for me. Very much puzzling. Why? We have been discussing all of this for at least, I believe, this is the 7th class. If you are the RBI governor, you want to promote growth, loans should be offered at a higher interest rate. You tell me, how does that make sense? You tell me, how does that make sense? No. Right? If you want to promote growth, people should take more loans. Companies should borrow more. And will they borrow at a higher rate of interest? Absolutely no. It's a basic idea in economics. Okay, so your interest rate should be lower. Now, right, I'll use this point. I will use this point. Follow the sequence. Follow the sequence. Very, very beautiful concept. Step number 1, RBI simultaneously will purchase 10-year government security and sell short-term government securities. RBI at the same point of time will purchase 10-year government security and sell short-term G security, which means money supply does not change. Step number 2, focus on this 10-year government security now. If RBI will start purchasing 10-year G security, what is going to happen to the demand for the G security? That specific 10-year G security, what will happen to the demand? Demand for this 10-year G security will increase. Now, if the demand for the 10-year G security will increase, what will happen to market price of this G security? Market price will also increase. And when the market price will increase, what will happen to yield rate? The yield rate of 10-year G security will come down. Now, please look at this. Please look at this. The yield of 10-year G security will have an influence over the interest rates in the market. Until now, before RBI did this, until now, imagine the yield rate was 8%. Right? Until now, yield rate was 8%. Now, because of RBI doing this, yield rate will fall down to, let's say, 7%. Now, simple question to all of you. When the yield rate will come down, can I say that now more and more companies can borrow from the market by issuing bonds, etc., at lower rate of interest? Let me know. Will it not allow, is it not an opportunity for the companies, private sector, others, etc., to issue bonds at lower rate of interest? Right? Until now, they were not able to do it because the rate of interest was higher. Now, rate of interest will be down. They will offer, let's say, 7.1%, 7.2%, 7.3%, unlike 8.5, 8.3, 8.2 in the earlier situation. That is how RBI will have an influence over the interest rates in the market by conducting Operation Twist. And when private sector will borrow more at lower rate of interest, is it not promoting growth in the economy? Is the logic okay? Right? That is point number 2 here. You're helping private sector to borrow at a lower rate of interest. Are you promoting growth or not in the economy? That is the whole idea. So please understand this carefully. This is a very, very beautiful concept. Why? RBI, without changing the money supply in the economy, is ensuring that the people are able to borrow, companies are able to borrow at lower rate of interest. This tool is called as Operation Twist. Okay. This is a particular tool used by RBI under open market operation. Okay, so this is a discussion regarding one more function of RBI. Any difficulty so far? First function is controlling inflation. Second one, I said RBI will help Government of India to borrow from the market. Third point, I've also written RBI will give loans to the Government of India. Does RBI provide loans to Government of India? Yes. Remember this. Does RBI provide loans to Government of India? Yes. RBI will also give loans to Government of India. I'll tell you when I discuss budgeting as a concept. There is one more concept called as a budget. When I discuss budget, I will tell you, right, how RBI will provide loans. So this is the second function. Third one, let me enter now the idea of monetary policy. Very, very important. Idea of monetary policy. Now, I've written the term monetary policy. They will also use the term credit control tools. They will also use the term credit control tools. Credit control tools. Now, let's start. The basic idea of a monetary policy is that RBI will use multiple tools to either increase or decrease money supply in the economy. I'll repeat the statement here. RBI will use a various set of tools either to increase or decrease money supply in the economy. Now, these tools are divided into two parts. One is called as a quantitative, second one is called as a qualitative. One is quantitative, second one is qualitative. In quantitative, RBI using these tools will regulate money supply. Regulate means increase or decrease. But remember this, RBI can overall increase the money supply. That is overall means in the whole economy, RBI can either increase or decrease. RBI cannot specifically target a sector. I'll repeat it again. Under quantitative, and you will understand in some time, have patience with me. Under quantitative, RBI can either increase or decrease the money supply in the overall economy. They cannot specifically target one sector or two sectors. For example, what I'm trying to say is, under qualitative, RBI can target only agriculture sector. Is the point clear to you? Under qualitative, RBI can specifically ensure that only in agriculture sector more credit will be issued, more money will be supplied, or money will be reduced. But can RBI target only one sector like this, specifically certain sector? Under quantitative, answer is no. Under quantitative, overall money supply in the economy will be increased or decreased. Now, these are certain examples of all these tools. Let's go one by one. CRR, BR, SLR, repo, reverse repo, OMO, open market operation. And after that, we'll take up qualitative set of tools. Let me start with the first one and the most important one, repo rate. Right? I'm pretty sure if you're reading newspapers, the term repo rate very, very often is cited. And again, it will come in the next month. Next month in the beginning, there is a monetary policy meeting. Again, it will come. Now, what is this idea for repo rate and reverse repo rate? Let me start with the repo rate. Have a look at this. Picture is given here. Step 1, RBI will give money to a bank. RBI will provide loan to a bank. And this loan, it is very, very short duration. I repeat, RBI will provide a loan to the bank, and this loan that is provided, it is of very, very short duration. It could be for 1 day, it could be for 7 days, it could be for 14 days, etc. Right? Very short duration. And when RBI will provide the loans to the banks, RBI will charge a rate of interest to the banks. And this rate of interest charged on short-term loans, it is called as repo rate. I'll repeat it again. Let me know if there is any issue. RBI will provide short-term loans to the banks, and on this loan, RBI will charge a rate of interest. This rate of interest is called as repo rate. Right? Under step 1, RBI will give loan to the bank and in return collect security. In return, collect collateral, bonds, that is government bonds. And let's say 7 days or 1 day, whenever the tenure maturity period is over, RBI will return the security or bonds to the bank, and in return, money, that is the principal amount plus interest amount, right, is given to Reserve Bank of India. That is basically the idea of repo rate. Any difficulty in understanding repo rate here? Any difficulty, please do let me know. Why they have a written bond when it is for a short term? My dear, I'll tell you a very basic idea. Imagine you'll go to a bank, you want to take a housing loan. Now, how many of you know that bank will ask for security? Let me know. How many of you know that the bank will simply ask you for security, collateral? In the same way, you have gone to RBI, you're a bank, you have gone to RBI and you're asking RBI, give me loan. So RBI says, I will give you loan, but give me security, give me collateral. That is basically the government securities or government bonds. Right? So step 1, you are a bank, you will borrow from RBI, you will give security to RBI. Step 2, you will return the money along with the interest to RBI. RBI will return the government securities or the security that you have kept with RBI. Right? That is basically the concept of repo rate. But understand the concept here. Understand this idea. Under repo rate, for what duration? It's basically a contract. It's basically an agreement. For what duration you're taking the money from RBI, that duration is fixed. It is 1 day. It is 7 days. It is 14 days. So the argument is simple here. If I'm a bank, I'll come to you and I'll borrow. And when I borrow, the duration is decided. I'm borrowing for 1 day. I'm borrowing for 7 days. I'm borrowing for 14 days. Can I say repo is nothing but it is a contract or an agreement? Let me know. It is basically a contract or an agreement between RBI and right the government. I'm sorry, RBI as well as a bank. That is basically right repo rate. Right, and optional level will go much beyond this. Repo stands for repurchasing order, etc., etc. But as far as I'm concerned, for GS paper, this is more than sufficient. Let me go to reverse repo. In the reverse repo, the banks will give loans. Let me explain first. Don't start asking questions. Listen first. The banks will give loans to RBI, and on these loans, the banks will collect a certain interest from RBI. And that rate of interest is called as reverse repo rate. I'll repeat it again. Under reverse repo rate, the banks will give certain loans to RBI, and on these loans, the banks will charge and collect interest from RBI. That is called as reverse repo rate. Now, many of you will start typing, sir, why will RBI borrow? What is the reason why will RBI borrow? It's not specifically that RBI borrows. Imagine you're a bank, you have 100 crore rupees. I hope you understand. Imagine you're a bank, you have 100 crore rupee deposits. Now you want to give a loan in the market, but it is very risky to give loans. There is a recession, right? People are taking loans, they are not repaying it. In that cases, don't you think you will prefer to keep your deposits with RBI? Let me know. Don't you think you'll prefer to keep your deposit with RBI, Reserve Bank of India? That is basically the concept here. On day-to-day basis, the banks will keep deposits with RBI. Will take their money, they will deposit certain amount of money with RBI. And on that deposit, RBI will pay interest to the banks. And that is called as reverse repo rate. Any difficulty here? Right? Any difficulty, let me know. Now, let me ask you a very simple question. Between repo and reverse repo rate, you tell me, according to you, which should be higher? Let me know. Between repo and reverse repo, think of it, it's a very simple idea. Between repo and reverse repo, according to you, which rate should be higher? It should be repo, my dear. Most of you answered correctly, but some of you are saying reverse repo. How? How does that make sense in your mind? Think of it. It's like saying bank will collect a deposit from you and they will give loan to you. And on the deposit, they will give you more rate of interest than on the loan. How? Don't you think RBI will simply go bankrupt because of this? I hope you understand. If RBI will pay more rate of interest under reverse repo compared to repo, don't you think RBI will incur loss there itself? And that's a basic idea. Okay? Repo is greater, reverse repo is smaller compared to this. Now, can I go to the next one here? Next, standing deposit facility. Right? Standing deposit facility. SDF. Very recently introduced. Very recently introduced. I don't think so there is anything given regarding this even in the book. Why? I believe only in the last year, at the very end of the last year, we have introduced a standing deposit facility. Now, what is a standing deposit facility? Please look at the definition first. It is the rate of interest charged by banks when they lend to RBI for short term. It is the rate of interest charged by the banks when they lend the money for short term for RBI. Now, don't start typing, right, sir? It is same as reverse repo. No. Have patience. Please have patience. Now, let me show you reverse repo. First, let me show you reverse repo. In case of reverse repo, what will happen? Here is a bank. Step 1. Here is a bank. Bank will take money and deposit that with RBI. Now, imagine you're the bank. You are keeping money with RBI now. will you not ask for security from RBI? Just like RBI asked you earlier under repo, now will you not demand securities from RBI? Yes. RBI will provide security, that is bonds, to the bank. This will happen in the step 1. In the step 2, here is a bank. The bank will give the securities back to RBI, and now RBI will return the money along with interest to the bank. This is what happens in a reverse repo. Now let me give you a very simple situation. Imagine you are the RBI governor. I am the bank. I will come to you and I want to keep a deposit of 100 crore rupees with you. I want to keep a deposit of 100 crore. And I'll say, because I'm keeping a deposit of 100 crore, give me securities equivalent to 100 crore rupees. Is it okay? Right? I'll keep deposit of 100 crore rupees with you. Give me securities worth 100 crore, collateral. Now, what if you do not have securities worth 100 crore rupees with you? Right? You do not have sufficient securities. Now, don't you think in that situation, reverse repo rate will fail? And was there a possibility of like this? Right? Sir, will it ever happen in the market? Of course, yes, my dear. Think of demonetization. Just think of demonetization. Now, during demonetization, what happened? People started depositing their 5,000 rupee, 1,000 rupee into their bank deposits. The banks have got huge amount of deposits. They want to keep those deposits with RBI. Right? But what if RBI doesn't have sufficient number of G securities at that point of time? Right? That is the precise reason. What RBI has done is they've introduced one more tool now. And that tool is called as standing deposit facility. Now, please look at the picture here. Please look at the picture here and here. Tell me, are both the pictures one and the same? Please observe. Are the pictures one and the same? This as well as this? Absolutely no. Right? In reverse repo, securities or collateral is there. In case of standing deposit facility, collateral is not there. Simple. In standing deposit facility, collateral is not there, which means the standing deposit facility is an instrument provided by RBI, wherein RBI will collect deposits from the bank and pay interest rate on this. But the RBI will not provide any collateral. RBI will not provide any securities to the bank. That is basically the tool called as a standing deposit facility. And now, does it make sense why they have introduced the SDF? Let me know. Does it make sense or not? Now, point number 2. Right? Point number 2. In a reverse repo, you will keep money with RBI. RBI will pay interest rate. And RBI will also give you collateral. You will keep a deposit with RBI. RBI will not provide securities to you. RBI will not provide collateral to you. Now, because the RBI is not providing any security, don't you think, compared to reverse repo rate, you are taking a higher risk under SDF? Think of it. Compared to, right, reverse repo rate, the risk that is faced by the bank under SDF is higher. Now, if the risk is higher, what should be the rate of interest here? Don't you think the rate of interest, that is standing deposit facility, should be higher compared to reverse repo? Some of you are saying lower. My dear, you are taking a higher risk. When you are taking a higher risk, you should demand more rate of interest. That is what economics says. Right? So here is, let's say, reverse repo rate. Here is reverse repo. And here is repo. Now, STF will be above reverse repo and below repo. Can I go forward now? STF, standing deposit facility, the rate of interest here will be higher than reverse repo and lower than repo. Point number 3. If you are going to earn a higher interest rate under STF, will you keep on, right, keeping the deposits with RBI under the reverse repo? Think of it. if you're going to have a higher interest rate under STF, will you opt for reverse repo? No, you will not opt. Right? Now that is a precise reason. Please have a look at this graph. Do not buy at anything here. Please do not buy at anything. Just simply make two observations. You will see only from certain time period, STF line has arrived in the graph. Only from certain time period, STF has arrived in the graph. And after STF has arrived, reverse repo rate line has disappeared. Let me know. Yes or not? This is from economic survey. This year's economic survey. What you'll see is from certain time period, the rate of interest representing STF, that graphical representation line has arrived. And from the point that STF line has arrived, reverse repo rate has disappeared. What does it mean? Reverse repo rate for all practical purposes is useless now. It is simply useless because the banks are choosing SDF, they are not choosing reverse repo rate. And right, if you're a banker, it makes more sense to you choose SDF rather than reverse repo rate, because obviously you are going to earn higher interest rate. And some of you might simply say, but sir, risk is higher. My dear, you're talking about RBI. Let me know. You're talking about RBI, Reserve Bank of India. If RBI cannot provide your deposits back, then imagine Indian economy has crashed. No doubt in that. If RBI says, sorry, I will not be able to give your deposit back, right, then simply means Indian economy itself is going to crash. That's the reason. Don't say, sir, risk is very high. Why should I choose this, etc., etc. And I'll tell you one more very important difference between reverse repo as well as MSF. Reverse repo rate, it is not available all the time. Is it okay? Reverse repo, it is not available. It's a facility, no doubt. But RBI will announce it. RBI will simply say, starting, let's say hypothetically, starting 1st of June, I will conduct, right, reverse repo. Is the logic okay? Starting 1st of June, for next 1 week, I'll conduct reverse repo. Meaning what? Only for that 1 week, reverse repo facility is available. What about this idea of the standing deposit facility? Standing deposit facility is available throughout the year. Remember this. Standing deposit facility is available throughout the year. And the key term here, please remember the trick here. The key term is standing. In concept of banking, whenever you come across the term standing, it simply means it is available throughout the year. Right? It is right to any working day. You can keep deposit with RBI under the STF. That is simply the concept of standing deposit facility. Can I go to the next one? Any difficulty here? What is the benefit to RBI? My dear, I told you, if RBI doesn't have G securities, they cannot conduct reverse repo operations. They cannot conduct reverse repo operations because they basically may end up running out of all the G securities that they have. But under STF, no danger of running out of G securities because RBI will not provide any kind of security here. Okay. If SDF is better than reverse repo, why do we still have reverse repo? My dear, what are you listening to? Why do you think I shown you this particular graph? This is the beauty of the kind of questions that students ask. Why do you think I've taken so much of interest in taking a picture from economic survey, putting in your PPT? Why? Do you think reverse repo rate is used even today by banks? Look at the graph and tell me. Please look at the graph and tell me, is there reverse repo rate after April 2022? If yes, then seriously, right? Please look at it. Okay, done. So the third one is STF. Let me go to the next one. Bank rate. What is the idea of a bank rate? It is the rate of interest charged by RBI on the loans given to commercial banks. Now again, some of you will simply say, sir, it is same as repo rate. Please look at the picture and tell me, is it the same as repo rate? I hope you understand this. Please look at the picture. That's the reason I'm giving you pictures everywhere. Is it the same as repo rate? No, it is not the same as repo rate. One repo basically is an agreement. It is a contract, right? While purchasing itself or while borrowing itself, there is an agreement for how many days it is done. And there is a collateral involved. Whereas in context of bank rate, there is no collateral involved. RBI will provide the loans, charge a certain rate of interest. Now, based on the discussion that we have had, you tell me, will the bank rate be higher or the repo rate be higher? Let me know. Right? You should understand all these concepts like this. Will the bank rate be higher or the repo rate be higher? Bank rate will be higher. Right? Repo rate, collateral is involved. Security is there. In bank rate, securities are not there. So obviously the bank rate will be higher compared to repo rate. Right? So this is one more tool used by RBI. That is the idea of a bank rate. Okay. Now, fifth very important tool, statutory liquidity ratio, SLR. Statutory liquidity ratio, SLR. Now, have a look at this very carefully. I'll introduce a concept of assets and liabilities of a bank. I'll go back to previous slide. Please don't worry. I'll introduce a concept of assets and liabilities of a bank. This is a picture. Please look at the picture. Understand this. And I believe 4 years ago, question was asked on the assets and liabilities of banks in India. Let's start. Here is a bank. Bank will collect a deposit. Now tell me, when the bank will collect a deposit, will the bank be under liability of repayment or not? Basic idea. Will the bank repay the deposit, give back the deposit or not? Of course, yes. Now can I call deposits collected by the bank as a liabilities of the bank? Done? Can I go to the next one? Deposits collected by the bank, any deposit for that matter, are nothing but liabilities of the bank. Second, the bank will issue loans. The bank will issue loans. And when the bank will issue loans, the bank will earn interest on the loans. Now, can I say loans issued by the banks are the assets of the bank? Any problem? Let me know right now. The bank will collect deposits. The bank will give interest to you. You are a customer. Bank will also give the deposit back to you, which means bank is having a liability. Deposits are liabilities of the bank. And second, the bank will issue loans and earn interest on it. So the loans or advances issued by the bank are the assets of the bank. Now, why is this useful? Why should you understand it? Let me add one more important concept here. The idea of demand and time liabilities. Idea of demand and time liabilities. So liabilities are further divided into two types. Liabilities are further divided into two types. One is called as a time liability and the second one is called as a demand liability. I'll start with examples. Automatically you'll understand. Savings bank account. Savings bank account and a fixed deposit. A fixed deposit. Now, simple question to all of you. Think of it and let me know. When you keep FD with a bank, don't you think the FD will be kept with the bank for certain number of days? For certain time period. It could be 1 year. It could be 2 years. It could be 555 days, etc. Now, such liabilities, I'll call it as time liabilities. Any problem? Such liabilities, I'll refer to them as time liabilities. Come to the other side. Demand liabilities. You have opened a savings bank account with a bank. Can you withdraw the money whenever you want to have a demand? Or whenever the demand arises, can you withdraw the money from your savings bank account? Answer is yes, by the way. If a bank says no, you are not allowed to do that, then they are cheating you. At any point of time, the demand arises, you can withdraw the money from the bank. Such deposits, I'll call it as demand deposits. Any problem? So the liabilities of a bank are further divided into two parts: time liabilities as well as demand liabilities. Now, right, come to the idea of a SLR. Come to the concept of SLR, statutory liquidity ratio. Statutory liquidity ratio refers to percentage of net demand and time liabilities. I repeat, right? A statutory liquidity ratio is percentage of net demand and time liabilities that the banks will have to keep with themselves. Please underline the term themselves. Right? Imagine a bank has collected totally 100 crore worth of liabilities. Okay, imagine there's a bank. The bank has collected 100 crore worth of liabilities. And let's say CRR is 4%. In fact, it is 4% now. Let's say CRR is 4%. What is the meaning of it? Out of 100 crore, the bank has to, sorry, SLR, not CRR, SLR. Let's say SLR is 4%. Out of this 100 crore, the bank has to take 4 crore rupees, and this 4 crore, the bank has to keep with itself. Is the logic okay? Right? How they will keep it, right? Why, etc. I'll explain it to you. Don't worry. The idea is simple. Percentage of the deposits that you have collected, please keep with yourself. Do not give it in the form of loan. Do not invest in the market. You are not allowed to do anything. Keep it with yourself. But there is an option here. What is the option? When you are a bank, let's say out of 100 crore, you will keep 4 crore with yourself. RBI says, I will give you certain options. That is, either you can keep this 4 crore rupees in the form of cash, or you can keep it in the form of gold, and right, you can keep it in the form of government securities. Okay, I'll repeat it again. This 4 crore rupees that is under SLR, you can keep it in the form of cash. You can keep it with yourself in the form of gold, or you can keep it in the form of government securities. That is approved securities, G securities. This is called as SLR. Now, right, there are two students who are asking, sir, give me the full form of NDTL and SLR. My dear, full form of SLR is just beside the acronym of SLR, and full form of NDTL is just beside NDTL. Right? They are there right in front of you. And this is basically the idea of SLR. Now, many of you ask, sir, why? Why does RBI have a tool like this? Why should the banks do like this? Now, think of it and let me know. Think of it and let me know. Here is a bank. Imagine I am the bank. You are Karodpati now. You will take 100 crore rupees and you will keep this 100 crore rupee in the form of deposit with me. I will take this 100 crore rupees. There are no conditions. Imagine, there are no conditions. I will take this 100 crore rupees, give it as a loan to Sri Vijay Mallya. Simple. The best example, all of you will understand. Right? I'll take all this 100 crore rupees because RBI is not telling me anything. I'll take all the 100 crore deposit that you have given to me. I'll give it as a loan to Sri Vijay Mallya. Now tell me, is your deposit risky or not? Yeah, your money, right, is facing a huge amount of risk or not? And that is the precise reason. That's a precise reason, right? Why RBI imposes certain restrictions on the bank. Okay, that's the reason RBI imposes certain restrictions on the bank. Otherwise, what the banks will do? They want to earn money. Banks want to earn profit. Just like any company, they also want to earn profit. If there are no restrictions, they will lend here, they will lend there, they will give loan to him, etc., etc. What if all these loans or a large number of loans, right, are not going to come back to the bank? The borrowers will simply run away. They will close down the company. In such cases, your deposits are at risk. And that is the precise reason, right? That's a precise reason. There are restrictions which are imposed as to how the bank is supposed to use these deposits. And these are referred to as statutory reserve requirement. Statutory reserve requirement. That is, the banks are supposed to follow these reserve requirements. Now, tell me, earlier I was discussing fractional reserve system, right? I hope you remember that. There was one table, right? The commercial bank money. And while discussing the commercial bank money, there was one table I said, if a bank will receive 100 rupee, the bank will not give all the 100 rupee as a loan. They will maintain certain reserves and remaining amount they will give loan. Now, does it make sense to you? Let me know. Now, the concept of reserves, does it make sense to you or not? Right. So there are two types of statutory reserve requirement. One is SLR that we have discussed just now. One is SLR that we have discussed just now. There is one more statutory reserve requirement, CRR, which I'll discuss now. Now, before going forward, please have a look at all the three. There are three options for a bank. Imagine you're a bank manager. You have collected 100 crore rupees. Out of that, let's say SLR is 4%. You have three options. Either you can keep it in the form of cash, you can invest in gold, or you can purchase G securities. Tell me, where will you invest or keep the money? Right? Will you choose A? Will you choose option A, option B, or option C? Where will you, right, use that 4 crore rupees? All of you will agree with option C? Option C is the right one, by the way. Some of you are saying gold. My dear, gold is very risky. Investment gold, very, very risky. Very risky. Trust me, investment in the gold is very risky. Right? So the banks invariably will choose, right, option C. Right? They will choose to invest in government securities because very, very safe. Very, very safe. Some of you might look at gold and say, sir, profit there. But my dear, what if customers will come to you and they want to withdraw money? You want to sell gold at that point of time, prices of gold have crashed. Let me know. Simple idea. Right? I've given 100 crore rupees to you. Out of that 4 crore rupees, you have taken it out. Remaining what you have done, don't worry. Now I'll come to you and I want to take the 100 crore rupee deposit back. You want to sell the gold because you want to give the money. When you purchase, the gold price was 50,000 rupees per 10 gram. Now it has fallen down to, let's say, 47,000 rupees per 10 gram. Don't you think you're taking a higher risk there? That is the reason G security, government securities are the best options, right? The best option for the bank. Okay. Sir, but earlier you said best way to invest is gold. My dear, for you, I said, for RBI, best investment is gold. And if you have been reading newspapers, central banks across the world, they have been purchasing a lot of gold. Central banks will do that, not these banks. Now, let me go to the next concept, CRR, cash reserve ratio. CRR, cash reserve ratio. Now, concept is similar with only one difference. Understand this carefully. In SLR, percentage of NDTL, the banks will keep it themselves. The bank will keep it with itself. Whereas in case of CRR, it is the percentage of NDTL that the bank will keep with RBI. It doesn't keep with itself. A bank will deposit that with RBI. For example, same number I'll take 100 crore rupees. Let's say CRR is 4%, which means out of 100 crore, the bank has to take 4 crore rupees, deposit this with RBI. Keep this money with RBI. And remember the next point here. On this CRR, that is a deposit that the bank will keep with RBI, RBI will not pay any interest. I'll repeat. On this deposit that banks will keep with RBI, that is a CRR, RBI doesn't pay any interest. And it is generally fixed between 3% to 15%. It is generally fixed between 3% to 15%. And another name for CRR is variable reserve ratio. The other name for CRR is variable reserve ratio, VRR. Done? Right? So these are the 5 very important tools. I'll repeat it again. One is a repo, right? Reverse repo. Then there is a standing deposit facility. Then there is a CRR. Then there is a SLR. 5 very important credit control tools. Now, I'll give you a statement. Let me know whether it is correct or not. If RBI wants to control inflation, RBI increases a repo rate. Correct? I'll repeat the statement again. If RBI wants to control inflation, RBI increases, repo rate. Now this is tricky. Second statement is tricky. Think of it and answer. If RBI wants to control inflation, it may increase SDF. I'll repeat the statement, right? Most of you will get stuck up there itself. Your brain will freeze for a second, right? So think of it. I'll repeat the statement. If RBI wants to control inflation, RBI may increase SDF, standing deposit facility. Correct or false? Correct or wrong? Correct. RBI can use even SDF to control inflation. How? Ultimately, what is the objective of RBI to control inflation? They want to reduce money supply. Right? Understand? How do you control inflation? They want to reduce money supply. Now you are a bank. Until now, I was providing you SDF of 4%. Now I will increase the SDF to 5%. Tell me, will you keep more deposits with RBI or not? Will you keep more deposits with RBI or not? Yes. And if you keep more deposits with RBI, what will happen to your lending? What will happen to money supply? Automatically go down. So can RBI use SDF also to reduce inflation, control inflation? Answer is yes. Right. Third, RBI will reduce the CRR in order to control inflation. I'll repeat the statement. Right. RBI will reduce the CRR to control inflation. True or false? Correct or wrong? Wrong. Some of you are saying yes. Think of it. Think of it. Right. Will reduce the CRR. Let me give a very simple example. You want to control inflation. And when you want to control inflation, you should reduce money supply. You should not increase money supply. Reduce money supply. Here is a bank. Let's say it has collected 100 crore rupees. Imagine right now CRR is 7%, which means the bank will keep 7 crore with RBI and remaining 93 crore rupees is available with the bank to provide loan. Now, if you basically reduce the CRR from 7% to, let's say, I'll take extreme example, 1%. Out of 100 crore, 1 crore will go to RBI and remaining 99 crore rupees will be there with the bank. Has money supply increased with the reduction of CRR or not? Has money supply increased with the reduction in CRR? Answer is yes. And RBI will reduce CRR to control inflation? No. RBI will increase the CRR, increase SLR, increase bank rate to control inflation. These are certain important points. Please remember them. This is what is asked by UPSC. I'll show you the questions. Don't worry. I'll show you the questions. This is how UPSC will test you. Okay? Done? Right. So we'll stop the discussion today here. We'll continue the discussion. Don't worry. We are basically discussing monetary policy of RBI. Out of functions of RBI, we're discussing monetary policy. We'll continue with other tools of monetary policy tomorrow. Let's solve the questions from taxation. Let's solve the questions on taxation which were left out yesterday. Let's finish it off today. Okay, let's start. Look at the statements very carefully. This is my advice to all of you. Look at the statements very carefully. Okay, 38% have answered correctly. Why? Some of you would have missed which of the following is not a feature of value added tax. Let's start. It is a multi-point destination based system of taxation. Tell me, is it a destination based system or not? That is the state where consumption will happen. Will the state get the VAT or not? I hope you understand. If you are the state government, I am selling this bottle in your state, right? You are going to impose a sales tax, that is a VAT, and collect it. That's right. First one is correct. It is a tax levied on value addition at each stage of transaction in the production distribution chain. Did we discuss this? I've given you an example. A will sell it to B, B will sell it to C. At every step, whatever is a value addition that is happening, on that we are imposing and collecting the tax. B is also correct. Third one, it is a tax on the final consumption of goods or services and must ultimately be borne by the consumer. Of course, yes. This is applicable to every indirect tax. I hope you understand. This is applicable to every indirect tax. Every indirect tax, ultimately the burden will fall on the consumer only. C is correct. Now look at this term. Look at this. It is basically a subject of central government. Do you remember this? I told you. I specifically told you this. The state governments implemented VAT, I said. Right? Earlier state governments had sales tax. The state governments replaced the sales tax with VAT system. And the statement says it is a subject of the central government. Now you tell me, sales tax is the subject of central government? No. Sales tax is a subject of state governments. So option D is the wrong one. Option D is wrong one. Okay. Any difficulty here? Can I go to the next one? Any difficulty? What does multi-point? Multi-point means, again, if you remember, A will sell it to B, B will sell it to C. I will collect a tax at step 1. I will collect a tax at step 2. Multi-point collection of taxes. Okay. Isn't it subject of both governments? My dear, sales tax. I'll repeat it. Sales tax comes under the state governments. State governments replaced sales tax with, right, the VAT system. Central government has excise. Sales tax is under the state government. Okay. Next. Okay, 63% have answered correctly, but again, some of you would be confused about current account deficit. Don't worry. Don't worry. We'll discuss that. There's a chapter called as international trade. I'll discuss what is current account deficit, what is exchange rate later. Please do not be worried about it. But I'll give you a trick here. There's a very simple trick. Whenever you come across the term drastically, suddenly, enormously, etc., be very skeptical in UPSC. Simple. Whenever you come across the term drastically, suddenly, enormously, guaranteedly, etc., right, be very, very skeptical regarding those statements. Why? Generally, they don't work out in the reality. For example, India's GDP is somewhere around $3.5 trillion now. I'll repeat it. India's GDP is somewhere around $3.5 trillion. China's GDP is 5 to 6 times more than us. Can you understand the statement? 5 to 6 times more than us. Now you tell me, if you implement GST, will it help India in overtaking China's GDP? Think of it. And some of you might simply say, yes, sir, it might. It might. Your argument is might happen. How can you tell? If it was so, don't you think India would have been implementing GST many decades ago? Not now. I hope you understand. If that was correct, Government of India would have implemented GST decades ago, maybe even after independence only, not today. Right? So that's a reason it will enormously increase the growth and size of Indian economy. No way, it is not going to do that. Now use that trick, eliminate. And some of you will simply say, sir, right 2 I did not know. Use the 3, right, eliminate, you have the right option. It will replace multiple taxes collected by multiple authorities and thus will create single market, national market in India. Okay. Now, okay, solve this question. Okay, 47% have answered correctly. It should have been much higher than that. A higher tax revenue can be collected by imposing higher tax on commodities. Let me start with the last one, which are habit forming. At least the last one should not be very difficult for you. Habit forming means which are consumed, right, by day to day in, day out by the people, such as tobacco, right, such as, right, let's say liquor products. Okay, so which are habit forming. So idea is very simple. You want to collect higher taxes by increasing the tax rate. Can we do that with the third one? Answer is yes. Any problem? Can we do in case of third one? Answer is yes. Which are having highly elastic demand. Now please go back to the class number second. We have discussed elasticity. Please go back to class second. When I said which have highly elastic demand, what is the meaning? It simply means even if you make a slight change in the prices, the demand will change by a large number. Do you remember that? Right? In fact, I'll show it to you again. Right? I have the same rubber in front of me. Do you remember this? Do you remember this? Rubber band. I'd use this and I said, right, is this flexible or not? Right? Flexibility. Right? That is elasticity. So argument is simple. Elastic demand means if you change the price by 1%, demand will change by, let's say, 4%, 8%, 8%, or let's say 10%, etc. Now, you will increase the taxes. What will happen to prices? Prices will increase. And if the product has a very highly elastic demand, what will happen to the demand? Demand will suddenly go down. Any problem with this? Demand will suddenly go down. Demand will fall by a larger number. Right? So in case of second one, by increasing the tax rate, can I collect more tax revenues? Answer is no. Because the price will increase, demand in the market will suddenly go down. And as a result of this, the tax revenue I'm collecting will be lesser. Can I use the second as the elimination and get the right option here? Because obviously the first one is exactly opposite, which has highly inelastic demand. For example, salt. Now tell me, can Government of India increase the tax on salt by 1 rupee and collect more tax revenues? Can Government of India increase the tax by 1 rupee on petrol, collect more tax revenues? Answer is yes, by the way. Some of you are saying no. Yes, my dear, answer is yes. Why? Will you reduce the consumption of salt? You tell me, right? Did we not discuss all of it? It's like basically we are at alphabet F, G, H. You are asking, sir, what was after A? Did we not discuss the idea of essential commodities? Salt, petrol, diesel. Right? Please revise. It simply shows that you are not revising. That's it. It simply shows that you are not revising. If government of India will increase the price of salt by 1%, you will not reduce your consumption of salt. You will continue to consume it, which means government is able to collect more amount of tax revenues. So 1 is correct, 3 is correct. Right option is option B. Done? Right. So we'll stop the discussion today here. Okay, we'll stop the discussion today. Descriptive questions are there. We'll solve the descriptive questions tomorrow. Don't worry. We'll solve the descriptive questions tomorrow. But meanwhile, if you people have any kind of questions, let me know. Let me address your questions. Sir, we are using yield in basic bond, coupon and yield topic. Do, sir, in place of yield and bond, is it possible to use other commodity? No, please don't apply yield, etc. to other commodities. Simply talk about yield, coupon, etc. only in the context of bonds. Right? Don't complicate it everywhere. Only in the concept of bonds. Bonds, the market prices will change. Yield will also change. And again, simple idea, my dear. If you feel that this is very technical, calculations you can't understand, you can't remember, your CSAT is very vague, I've told you a trick. UPSC, you don't have to become a master of every subject in UPSC. Please understand that. Market price in the yield rate are inversely related. Right? When the market price will go up, yield rate will go down and opposite. Simply remember that. Right? That should be more than sufficient. And if you check any GS paper book, none of the book will discuss yield rate and coupon rate. Trust me, you check it. They will not discuss it. I know that. What is SDF? Standing Deposit Facility. Under Standing Deposit Facility, the bank will keep deposits with RBI and RBI will pay rate of interest. That rate of interest facility is basically standing deposit facility. And in that, RBI will not provide any security, any collateral to the bank. Will higher SDF rate of interest impact a loan to common people? That's what I told you. I've explained it. If RBI starts to increase SDF to a very high level, banks will start depositing more money. And if banks will deposit more money with RBI, automatically the flow of the deposits, right, in the form of lending will be affected. We have discussed this. Any difference between coupon and repo rate? My dear, I don't understand, right? From where do you get these kind of questions? This is a bond. What is the coupon rate? Let me know. This is a bond. What is the coupon rate? 8%. Now, you will go to RBI. You will take a loan of 100 rupee. RBI will ask you for a collateral of 100 rupee. That is G security worth 100 rupee. Right? That is a different concept. And on the loan that is given, RBI will charge rate of interest. So you are talking about coupon rate, which is related to bond. You are merging that with repo rate, which is associated with RBI lending money. All these concepts are different. Why do you complicate, bring everything into one and just complicate everything? Okay. Bonds are of government only, right? No. Bonds can be issued by the corporate sector. Bonds can be issued by the government also. Okay. You told that elastic is luxurious products and increase in the price will not affect the demand. How? Where I have said? Check it. I said for essential products, prices might change. Demand will not change by much. Please go back. Please check the PPT. Right? Please revise. You're not revising. I said rather on luxury products. In case of luxury products, If the price changes by 1%, demand will change by a large percent. Please go back, check the table. In fact, I've given the table also. In simple words, can we say that yield rates is nothing but return on the bond? Again, return on the bonds, actual returns you can say, because we are calculating yield rate in terms of percentages. Okay. Please type your question. Please type your question. I'm not able to see the question. Some of you are saying, please answer my question. Rather than saying, please answer my question, right? Copy and paste your question so that I know what is your question. What is NDTL? The banks will collect deposits in two different forms. One is a demand deposit, another one is a time deposit. You take the sum total of both the time and demand deposit and basically adjust. There are certain adjustments, make adjustments. What is left out is net demand and time liabilities. Okay. Do I need to follow book A or book B? Left to you. Entirely left to you, right? There is no one book that will provide all the information to you. As per your requirement, use any one reference book. What is SLR? Statutory liquidity ratio. Percentage of NDTL, that the that the banks will have to keep with themselves in the form of either cash, in the form of, right, let's say G securities, or in the form of gold. Right? What is the percentage of NDTL that they will calculate and the banks will keep it themselves? That is SLR. Okay. What is intrinsic value? My dear, you tell me. I'll hold a piece of paper on one hand and I will have gold in the other hand. Can you see the gold ring? Let me know. Can you see the gold ring in my hand? This is gold and this is piece of paper. Tell me which of the two have value in the market. That is intrinsic value. Which of the two have, right, intrinsic value, right, market value? Obviously gold. Piece of paper, right? If Government of India tomorrow announces white piece of paper is equal to 100 rupee, then it becomes worth 100 rupee. So obviously commodities will have intrinsic value, not, right, fiat money. Can the state government issue G securities? I'll tell you tomorrow, but anyways, state governments are allowed to issue G securities, that is bonds, and the state government bonds are called as state development loans. Could you summarize Operation Twist? I'll quickly tell you in a minute. In Operation Twist, simultaneously, RBI sells, RBI purchases same value of G securities. Focus on buying. Focus on the buying. RBI purchases 10-year G securities. Demand for the 10-year G security increases. Market price increases. Market price is inversely proportional to yield rate. Yield rate in the market will go down. And as a result of that, interest rates in the market will fall. What is this graph of reverse repo? My dear, there is nothing to explain in the graph of reverse repo. Right? You're basically focusing on unnecessary things. The graph that I shown to you is just for observation. I said CRR, I'm sorry, not CRR, reverse repo. Right? You can see reverse repo rate being represented until certain point of time. After that, reverse repo rate is not represented. You will see SDF, which means today, for all purposes, reverse repo rate is useless. Banks are using SDF. That is what I said. Is Operation Twist in current use? If not, why? Do you think economic situation today is the same as it was in 2021? You tell me. Do you think, because you're asking why is not Operation Twist not used today, you tell me, is the economic situation same as it was in 2021? Of course, no. That's the reason RBI is not using it today. What is MSF? I'll discuss that tomorrow. Salt is an exception. It is not credit to higher tax revenue. My dear, take petrol then. Right? Generally, people try to find out a loophole with whatever answer I gave. Tell me petrol. And again, if you're reading newspapers, you'll say, yes, in case of petrol and diesel, government of India, state governments in the last 2 years have increased the tax rates and they have been able to collect huge amount of tax money. And the argument is very simple. Petrol, salt, everything is an essential commodity. What the price is, you will not change your demand. You will continue to consume the commodities in the market. That is more important. Okay, done. So let me stop the discussion today here. Tomorrow we'll continue with another part of the monetary policy tools. That is the other set of credit control tools. Done. So let me stop the discussion now. Thank you. Take care. Have a great day. Good night.